as I told you already, so we'll fix a plan. I'll come to that campus side, and then we can have a plan.
Yeah.
Minimum tea I can afford, don't worry. Kidding only. So yeah,
Sure.
we'll start. But I'm not able to share still, Munesh. I don't know. I'm not able to share my screen from here.
हाँ सर शेयर है सर, सर क्लास शुरू करें सर।
हाँ मैं कर सकता हूँ, बट मैं स्क्रीन शेयर नहीं कर पा रहा हूँ भाई, तो मैं कैसे करूंगा? मैं ये बोल रहा हूँ कि मैं इस
सर
पे
ये तो
शेयरिंग का।
आपको करना होगा सर, इधर से ऑप्शन नहीं है इसका।
ओके ठीक है, मैं एक बार मीटिंग, आप रहना अभी, मैं एक बार मीटिंग छोड़ के दोबारा करके देखता हूँ।
जी सर, जी सर।
मुनीष जी नहीं आ रहा है ऑप्शन, मैं शेयर नहीं कर पा रहा हूँ इसमें। क्या गड़बड़ है इसमें? कोई ऐसा सेटिंग है कि मैं नहीं कर सकता, या सिर्फ ऑर्गेनाइजर, या पता नहीं, इसमें आ ही नहीं रहा है इसमें वो।
टीसीपी इंचार्ज है हमारे, वो लाइन पे लेंगे अभी आपसे, वो बात करेंगे।
सर
ठीक
आप
है।
प्रेजेंटर नहीं हो।
तो मैं इसको मोबाइल को लगाऊंगा उस पर, तो बताएंगे फिर इनको सर को। हाँ बोलो सर, हाँ बोलो। हाँ बोलो, मोहित कुमार सुन रहे हैं सर, बोलो। उमेश जी। हाँ बोलो ना, वो बोलो, सुन रहे हैं। मोहित सुन रहे हैं, मोहित सर आप बोलो ना।
हेलो मुनीष जी, कुछ शॉर्ट आउट हुआ?
मैं लाइन पे ले रहा हूँ सर, जरा बात कर रहा हूँ सर।
ठीक है। आई थिंक ऑर्गेनाइजर हैज टू मेक मी द प्रेजेंटर, आई थिंक, मतलब मेरे को एक्सेस नहीं है टू प्रेजेंट।
यस सर।
हम्म। सॉरी गाइस, मैं 1-2 मिनट और वेट कर लेते हैं, अदरवाइज जब तक ये लोग मेरे को प्रेजेंटर बनाएंगे मैं ऐसे ही बोलना भी स्टार्ट कर सकता हूँ अपनी साइड से पीपीटी ओपन करके. So then we can start this session at least because it's a 5 hours today. It's a marathon. Uh, we have to finish it by 10. So it's not like we should go for 5 hours, but we'll see. We'll try to finish it. I'll try my best to cover all the units. In between, I'll share all the study material again so you guys can revise
आवाज आ
that.
रही है? सर को बात करो जरा, मोहित राहुल। हेलो।
हाँ जी
हाँ
राहुल
सर,
जी.
मोहित।
हेलो. हेलो. हाँ जी बोलिए.
कह रहा हूँ सर, शेयर का बटन होगा उसमें।
भैया वो तो मेरे को भी पता शेयर का बटन है उसमें. शेयर करने का मेरे को एक्सेस नहीं है उसमें, अथॉरिटी नहीं है मेरे को
हाँ तो
उसमें.
शेयर वाले उसमें ही जाके आप फिर वो जो उसका फोल्डर है वहां एक्सेस करो सर, क्या हो गया उसमें।
कहाँ पे एक्सेप्ट करो?
सर उसी को एक्सेस करना है, पहले शेयर वाले बटन को क्लिक करो, फिर उसमें एक्सेस करना, एक्सेस का ऑप्शन आ रहा होगा।
नहीं आ रहा भैया, नहीं आ रहा. हर बार करता हूँ ना, मतलब क्लास तो हर बार ऐसी जाती है, इस बार नहीं हो रही है.
So your
राहुल तुम
share
कहाँ?
button is disabled or it is enabled? Share button.
इट्स डिसेबल्ड एक्चुअली.
Yeah. So actually the share button itself is disabled. Na? So whoever is supporting you, I mean, I think we should tell them that, the button itself is disabled. We can't even go inside.
या दैट्स व्हाट आई एम ट्राइंग टू से कि
राहुल तुम्हारे वहां से हो जाएगा। अब तो ये इनको नहीं समझ में आ रहा, तो टीचर ही करेंगे, तो अब वो कैसे कर पाएंगे? अब करेंगे तो वो ही, करना तो उनको ही है। सर शेयर का बटन होगा, इसको शेयर के उसको क्लिक करो सर, उसी में एक्सेस का आता है।
मुनीष भैया सुनो, मैं पहली बार क्लास नहीं ले रहा हूँ. शेयर का बटन डिसेबल्ड है, शेयर के बटन पे मैं क्लिक ही नहीं कर सकता, तो मैं
राहुल
कैसे इसको
डिसेबल्ड आ
एक्सेस.
रहा है, तो फिर क्या होगा इसमें?
आपको प्रेजेंटर
डिसेबल्ड आ
बनाना
रहा है।
पड़ेगा सर को।
So you're logged in as Mohit Kumar.
हाँ सर, वेट वेट करो सर, वो है उधर लाइन पे।
नो,
No.
MBA।
Yeah, you
राहुल,
have to log. Yeah. So you're not a presenter then. Yeah.
राहुल अब खोल के जरा अपने वहां से सिस्टम से करो उसको। राहुल सिस्टम पे हो ना तुम? मोहित कुमार के नाम से, इनका सर का नाम मोहित कुमार ही है सर, मोहित कुमार के नाम से लॉगिन है ना
नहीं नहीं,
आपका?
एमबीए के नाम से, एमबीए के नाम से.
MBA। MBA के नाम से है।
हाँ अभी आ रहा है, धन्यवाद सर, बहुत बहुत धन्यवाद, आ गया अभी.
सर हो गया है, राहुल हो गया है। मोहित सर आवाज आ रही है?
हाँ जी हो गया, थैंक यू सो मच.
मोहित सर,
हाँ।
एक आपसे रिक्वेस्ट है कि आप अपने नाम से ही उसे कीजिए, क्योंकि फिर हम कैसे आइडेंटिफाई करेंगे, क्योंकि हमारे डिस्क्रिप्शन में तो आपका नाम आता है ना। अब हमें कैसे पता है MBA के से आप लॉगिन कर रहे हो, फिर कैसे
सर जी
प्रेजेंटर बनाएंगे?
सर जी आप ही ने दिया ये नाम मेरे को, कोई आनंद करके हैं, उन्होंने दिया था मुझे ये नाम. मैं
ठीक है
तो
सर।
एमबीए.
ठीक है, आप उनसे आप ये चीज ना आप अपने नाम से चेंज करा लेना एक बार।
चलिए ठीक है, अभी मैं क्लास के लिए सर लेट हो रहा हूँ, इस आर्गुमेंट के लिए
ठीक है
टाइम तो
आप।
नहीं है. आप
हाँ
रखिए,
नहीं,
मेरी वैसे भी रिवीजन क्लास है,
सर
आप
रेडी टू
प्लीज
गो सर,
मेरे को प्रेजेंट करने दो.
आर्गुमेंट नहीं सर, नेक्स्ट आगे भी तो क्लासेस होंगी, मैं इसलिए कह रहा हूँ।
नहीं नहीं, मेरी
जी
कोई
सर।
क्लास नहीं इसके बाद सर, प्लीज आप मेरे को क्लास लेने दें अब. थैंक यू.
जी सर, सर ठीक है सर। ओके सर।
Guys, the screen is visible.
Yes, sir.
Okay. So thank you so much and sorry for this delay. Uh, so what we started this unit, like there were 5 units. One unit was covered by Manisha ma'am, and we started with the introduction of the fixed income securities. Some of you have, like, I still Bhavna and Atul, like they always have been in the class, so for them it would be a repetition. So I think remaining, I don't know how many of you have attended all previous classes, but what will I do? Please do not expect that I'll go in details, because in 5 hours you cannot complete the classes which we took almost 16 to 18 hours. So I'll just go and quickly do revision. There are some study materials also I will share with those. Bhavna and Atul you already have, because you already attended all these classes. But just for like at single place you can have all the access, so I will share again, and that would be kind of revision for you guys also. You can just read them again. I will give time. So first we will try to cover as much as possible, at least for 2 hours continuously we'll try to take this class, and then after that we will do this reading things and all. Then again we will try to cover, so we will try our best to cover this within next 3 to 4 to 5 hours, whatever time it takes. Okay, meanwhile, if you want to take some break and all, please go ahead and let me know. Okay, so let's start this with the. So we started with fixed income securities. Objectives and learning outcomes is already there in your syllabus or the book you got. So the first part was covering fixed income security markets in India, then money and debt market instrument, then market regulation, reforms and issues, and interest rate determination. So first we started what is fixed income securities and markets, where we were discussing about that you should go with the name of a whatever concept you are going to discuss. First you start with the name, and then the definition would always be clear. So in future also, at that time I also told you, before just rushing to Google or rushing to book, just think that concept 2 3 times in your mind. I think the definition would be more clear. So the fixed income security is like security which provides you fixed income. Fixed income in the form of what? Fixed income in the form of coupon payments, and the principal payment you will get at the end of the maturity. So the definition was that fixed income securities, also known as fixed income investments or debt securities, are financial instruments that represent a loan made by an investor to a borrower. These securities typically pay a fixed interest or coupon rate to the investors at regular intervals, usually semi-annually or annually until the maturity date when the principal amount is repaid. So you can see that bold and italics are the components of fixed income securities. It has, like, first of all, it is financial instruments. Second, you have an investor, you have a borrower. Again, the component is it has fixed interest in the form of coupon. Other component is it is like it will be paid at regular intervals. It could be annually, semi-annually, quarterly, monthly, whatever. There would definitely be a maturity date at the end of which your principal amount will be repaid. Okay, so this was the definition of fixed income securities. Now coming to the fixed income market, the place where your fixed income securities will be traded. Okay, where you will buy and sell the fixed income securities, that becomes your place, or we can call it a market. Okay, now coming to the second thing, we were discussing about how it has evolved over the time from like ancient era till the modern world today. So there have been multiple dimensions, multiple changes took place throughout the time period. How it started in a very small form in Mesopotamia, where people used to promise to each other that we will pay a fixed amount of grain or fixed amount of whatever. Then that's how it started, because what a barter system that time, the currency and all was not there. Then after some time this government started taking its structure form, and then they come and it started becoming little bit official and recognized form of trading and all. Then after that we saw another era where trade started picking up, and then there are another concept come like innovation of borrowing. So there were governments actually that time, the Dutch government and all, they used to borrow from their even public, and then they used to offer promise them a fixed amount of payment or something. It happened in Venice also that time. The king of Venice actually promised their during to fund the war. He promised the public that if they give him like 1 rupee or something, he will pay them 1.25 or 30. And that was officially kind of incident. I'm not claiming that it is written, but these are some kind of stories you read in fixed income securities or finance books and all. So that time he promised, okay, he will pay them 1.25% of whatever amount they will pay, and that was kind of some official loan he took from the public. And after winning the war, I think he repaid that also. Then we had industrial revolution came in 18th to 19th century, and then corporate bond concept emerged when even apart from the government, corporate firms, business firms started raising fund through loan and bond, and that it became very popular that time. Though still in developing economies, it is still an issue, and corporate bond market is not as developed and dynamic as it is in developed economies. But now but this was the time when actually they started funding their investment activities or big product activities through this corporate borrowing and all. Then because it whenever this kind of things happen, finance comes and all, there are chances that it may exploit people or the money, since it is your hard earned money. There should be some kind of regularization or some kind of it should be standardized actually. Otherwise there would be no accountability and all, and you may lose your money. So then it was a time when this regulation and all started taking its place to protect the interest of investors. Then in 20th century, that this is the economy, this is the era which we called, okay, the world started the countries started expanding their wings to other economies, and export and import started taking its place. Then it became more popular actually, because when you want to export, or you want to spread your trade to the other economies, you cannot just heavily rely on traditional source of finance through bank and all. You need to borrow money, and then this concept became more important. Then market diversification happened, and then recent technology also took place, like online trading and all, and it became more popular through more information access people had, information asymmetry started reducing, and then people started becoming the active participants in the fixed income market. Now coming to the 21st century, this is the time when actually all the structured products came, like they started bringing some innovative product, mortgage-backed securities, securitization started happening, and then new instrument they started bringing. We saw this credit default swap during 2008 financial crisis also. How it became popular and how it got set back. We saw the CDO, we saw this mortgage-backed securities. Market became more globalized, and then they started, instead of risk, just a return aspect or just to promising a fixed payment, they started focusing on the risk management, especially after 2008 financial crisis. And this happened because in these slides also we covered this how the different crisis became an issue, and how people started taking more precautionary not people actually, at least regulatory authorities started taking more precautionary measure. And that happened during pandemic and all also. Now this is the time when we are discussing, or we are taking this lecture about fixed income securities. It is very highly modern time, where not only this fast technology or online trading platform, but AI started taking its place. Now people are making more informed decision based on different digital tools, methodology, AI. And now you have, I think, all of you now know what is happening now since this chat GPT and all came. People are don't rely on them heavily. Actually, first of all, a disclaimer is there. Uh, you need to verify the information you are trying to get it and all. But people started becoming more aware and all. Now you have access to internet. You have access to YouTube or whatever, and people are actually, even I'm surprised nowadays people have much better information about trading than it used to be like 5 to 6 years back. And now even school kids are started talking about option, put option. I don't know how much they know, but at least words are always there. Okay. Now, but what happened whenever you talk about any market, equity market or fixed income market, but there are chances like that bubbles will be created, or there could be hype. No, nothing is like risk free. There would definitely be risk. And what happened when you grow these kind of markets and all, and there's a kind of setback, if some crisis happen, or some kind of incident happen, like it happened during this Middle East crisis also, now it is happening. there's always a setback. But what happens, fixed income securities actually sometimes was promoted by this kind of crisis. So I'll tell you, for example, we saw different crises. Let's talk particularly after 2008, because before that also there were so many crises. 1929 it happened, then oil price crisis also sometimes happened, then internet bubble happened around 2000, then Russian default, not Russian default, Asian financial crisis happened in 1997 around. So but what happens sometimes whenever these kind of crises happen, they somehow promote fixed income securities, though even fixed income securities are not risk free. So for example, during 2008 financial crisis, when Lehman Brothers failed, there was a buzz, or at least developing economies started focusing more on having a local currency bond market. Local currency bond market, the advantage is because it will not reduce the dependency on the banking sector, but will make the economy more resilient towards external economic shocks. They don't need to be dependent on on foreign capital and all to finance their investment activities. And emerging economies, particularly like India or China and all these economies, there's a report from Asian Development Bank side that these economies, particularly in Asia, if they want to tackle the climate change issues or alleviate the poverty and all, they need to boost at least 1.7 trillion USD per year into market infrastructure. And this is not like just in next 1 year or 2 years, this is up to minimum 2030. World Bank also recently issued a report there. They said Asian economies, particularly emerging one, they are the largest economies in terms of when it comes to need to invest in the infrastructure and all. So it is so like if you are just dependent on the banking sector and all, this cannot fulfill the demand, because there would be some asset liability mismatch issue will be there, in the sense that they should not have more liabilities than their assets. If that is the case, there are chances that bank may go fail, or bank may go insolvent, and that would be definitely a huge setback, especially if the bank is too large, such as SBI, or like it happened in Lehman and Brother case also. So, but definitely to promote those, or to continue your growth activities or investment activities, you need to invest definitely in the infrastructure, and for that you cannot just rely on the banking sector. Okay, so what happened then? They with this Eurozone debt crisis actually was a debt crisis also. That's what I'm saying. That fixed income is not just free of risk. If the government, even government can go on default. But during Chinese stock market crash also, what happened? People started shifting towards either corporate bond or sovereign bond. COVID-19 pandemic also boosted somewhere, and now it was happening Russia Ukraine. What happened generally in emerging economies? Investors are risk averse. We have limited money, our per capita income is low, so we don't want to take risk all the time in the equity and all. So people generally shift towards fixed income securities so that they can have a better or they can have some kind of protection. But if your market itself is not very efficient or not very developed, then it will become another issue. So that's why after this kind of crisis, people started putting more focus on fixed income securities and all. And these are some news headlines which actually telling you, sorry, started telling actually that fixed income securities are taking place and becoming a favorite investment avenue for the investors. Okay, and in the recent trend, these are some graphs which I took from some business magazine called Markets in a Minute. It is telling actually what is how the dynamics about fixed income market is around the world. So for example, US is the largest player, and then we have China, then we have Japan, even Europe, and some small countries are much better than India. And you can see India's share is here only, and you can, if you compare Indian economy with any of this economy except like US and China, much larger than all these economies. But see the bond market size. So this shows that there's a huge need to put efforts to develop this local currency bond market, so that we can start investing our we can keep continue our financial or investment activities. Okay. Now coming to the who are the market participants in the fixed income market, it can be like divided in both the side, like demand side and supply side. When it's come to demand side, it could be individual investors like me and you. Then we have institutional investors like who have with bulk of money, like pension funds, insurance companies, mutual funds, exchange traded funds, then we have hedge funds, we have foreign investors also, we have central banks. Supply side who issue actually their securities and in which you can invest. So in India particularly, the government is a major player. Almost six, the corporate bond market actually is overshadowed also by the developed bond market. I should not use word overshadowed, but yeah, we have more developed sovereign bond market compared to corporate bond market, which covers more than 65% of the total market shares. Okay, in the government, it is both that national and local or state government. Then second, we have this corporation like public or private companies. They also raise money by issuing debt and all. They issue we call them when they issue the bonds. We call them corporate bonds and all. And then we have international organizations. They also want to raise sometimes money, like if they want to raise money in Indian currency and all, sometimes they do that also. We have financial institutions like bank and brokers and underwriters. So for example, banks, you must have heard like sometimes they have statutory liquidity ratio or cash reserve ratio. Apart from that, uh, they have this continuous obligation, so they cannot play around the money. They have to pay on time. Whenever you go to a bank, that bank is has an obligation that they will pay whatever amount you want from them from your account. So for that, they can't take risk. Either they go for the government bonds or corporate bonds because that is a constant source of income for them and that would be fixed. Then we have brokers and underwriters. Coming to the intermediaries, we have bond traders, then market makers, bond rating agency is not actually issuer, but bond rating agency plays role. Based on the information, the rating they provide to the instruments, you actually take your decision to invest. So generally, they put them supply side because they provide that necessary information for you to make an investment decision in the fixed income securities. Okay. Then here, I think I remember I shared to um, study materials with you. If you remember, I think one was about sovereign bond and one was about corporate bond. I shared with, I think, Atul and Bhavna, they might have remember. I shared here something like so just to tell what is the difference between investing in government bonds and investing in corporate bonds. So you can just read directly here. So government bonds include such as treasury securities or other fixed income securities like 10 years yield bond or 15 years yield bond or short term premium notes and all. They actually have low credit risk, or sometimes I say it is a zero risk securities, because we always believe that government will not go on default. Okay. Same way, they also have coupon payments, like they provide as regular income and they have their face value also. Okay, then they continuously monitor the interest rate movements and understand that board price just to help the investor in managing their risk. So they have all the characteristics which is similar to corporate bonds, but corporate bonds has actually relatively higher risk compared to government bonds, and that's why this rating concepts come more for the corporate bonds because they are considered as a risky investment and all. So the only difference is like they are the corporate bonds are relatively high risk here. So sometimes we say triple A rated bond or triple A plus rated bond, the highly secured bond from the corporate side, but still they are not as safe as government bonds. And we have seen so many times that despite having triple A or triple A plus rating bonds, many companies went on default and could not pay their obligations. Okay. Now we have fixed income security. What is the difference between fixed income securities and equity? Many of you know all these things. So first, the first comes like, first of all, fixed income securities are debt or loan, but equity securities present the ownership, and this is the main difference actually. The one is just whenever all the things and all you can talk a lot, but this main difference, whoever asks, like whatever it is, the main difference is one is ownership and one is loan. That's it. Issuer could be like governments or corporation or municipal. Hello. Okay, sorry. And either this side, equity security side is just a company. Return type is a fixed interest payment, whereas equity securities, if the dividends varies, they don't pay you coupon, they pay you dividend, and this is not actually compulsory. They have capital appreciation, but in case of fixed income securities, you will have fixed your principal payment, which you bought the security on, and then you will get the same amount at the end of your maturity. Risk actually it varies. For fixed income securities, relatively it's low, but for equity, the risk is high because price fluctuation volatility is more when it's come to equity. In bankruptcy, priority in bankruptcy, yeah, definitely it's a loan, it's a debt, so definitely you will get priority, and equity owners will be paid, I think, as a residuals, but not uh, as the first preference will not go to the equity participants. Okay. Length also, it's a defined maturity date, but it is perpetual. There's no maturity date. I am and then when it's come to voting rights, yeah, this is aligned with the ownership. Since equities are the ownership, definitely they will have voting rights as shareholders, but fixed income security, they are just giving you loan, they don't have any voting rights. Then coming to the taxations, and then we have exam taxation also, it varies, and now you have to see the regulation and all. Sometimes capital gain tax are taxed, sometimes in some tax assessment here they just give them exemption and all. Right now I'm not pretty sure what is the condition of putting tax on capital, I think principal amount or capital gain. So that is something vary year by year. Examples, we have bonds, notes, bills, CDs. CDs are certificate of deposits. Then we have common stock and preferred stock under equity securities. Similarly, I'll share this slide also with you. You can go with what is the difference between securities and preference share. Nothing, same only. Only thing is the one common thing was there, that the ways fixed income securities had fixed amount of coupon, preferences generally they say they have fixed dividend payments on lower. So remaining differences are similar as the difference between equity and fixed income securities. So you can go one by one with these also. Now we have bills versus bonds. So they both are debt securities, but the major difference which I told, that bills are for short term, bonds are for long term. So bills could be like 30 days, 90 days, 180 days, and 1 year. So they are generally less than 1 year, and they have different maturity from like 30 days to 90 days. Mostly 91 days treasury bills are more popular, especially in India and US and all these economies. Bonds generally are for longer term, not only for 10 years, 20 years, but generally after 2 years, 5 years, 7 years, 10 years, 15, 20, this kind of maturity they comes under, and they are called as bonds. So they are generally having longer maturity. Issuers, it mostly bills are mostly, actually mostly they are being issued by the governments only, and whereas bonds could be like government bonds or corporate bonds, as we discussed. Okay, then we have difference on the basis of interest payment. They are generally sold at discount. They may not, because definitely they are 90 days. What periodic payment you want from that? So they are generally sold at discount, and you will get the maturity price, and that the difference would be your gain. Okay, then you have principal repayment. Both are paid at maturity. Trading, definitely they are highly liquid because governments try to raise funds in the money market to fulfill their short-term needs. And similarly, bank also, they go ahead with the commercial paper certificate of deposits. Then corporations go for commercial papers and all to raise funds in the money market. So generally, the overall, what I'm trying to say, the difference between bills and bonds is bills are mostly for short-term maturities, whereas bonds are for long-term maturities, and bills are mostly issued by the government of India or government of whatever country you are referring to. Okay. Okay, this is the question actually someone asked, so let's just skip it because I don't know who asked this question. I try to answer that question. Now coming to the money market instruments, now we have okay, money market instruments are like bills. So all the instruments which are issued for the short term or being traded for the short terms are called money market instruments. Okay, they start even from overnight and go up to the 1 year, or sometimes we talk about in terms of weeks, 4 weeks, 30 or 48 weeks or 52 weeks, like that we talk about them. So T-bills we have already discussed. This is money market instrument because it is for short term. Now we have commercial papers, because commercial paper actually are issued by the corporation when they want to raise fund in the short term. The security or the instrument they issue are called commercial paper. At the same time, we have bankers acceptance, which become more popular when it comes to export and imports things, where one person writes bankers acceptance and bank says, okay, I'm guaranteeing you, you just issue the stuff to that particular person, and on behalf of him, I'm guaranteeing you that I will I will make you a payment. Then we have repurchase agreement. This is mostly famous between central banks and other banks. When central banks want to, whenever central banks give the money to commercial banks and all, the rate that he charges is called repo rate. And what happens after some time, the promises, okay, I will take this money back at a different rate. So this is called repurchase agreement. I will repurchase your agreements, okay, in future. Now we have certificate of deposits, which is mostly are issued by banks, like commercial paper are issued by corporations. Certificate of deposits are issued by banks. We have euro dollar deposits when you want to issue fund, you want to raise money in the market other than that particular economy, then you go for euro dollar deposits. Like you want to issue raise US dollar bonds, or you want to raise or you want to get some bonds or sterlings and whatever, you generally go for euro dollar bonds. And then we have municipal notes, as we discussed. This is about the local government when they want to raise funds to from the public. Okay. Then again, we had debt market instrument, is treasury notes, municipal bonds, corporate bonds, convertible bonds, mortgage-backed securities, asset-backed securities that we just discussed right now. Okay. Then we have more recent structured products like collateralized debt obligation, where the value itself is derived from other types of loans. So there would be multiple loans. They will club all these loans together, and then we'll make some kind of trans, like different trans you can, and then they will sell it to the public. The value of those trans will come from the loan, they from that club of loan. So the way you will keep paying for your loan, they will keep paying for to the next people. Okay, so for example, there are and they have category, like it could be risky, it is low risk, and it is higher risk, like this, or moderate risk kind of. And that's how they are like we generally call them structured products, because they are not actually they are not deriving their value from their own assets. So there's no um, buildings or fixed assets and are backing them. They are just are being backed by other loans and all, which has been clubbed by the issuer, and now they are paying you the interest and all. Then we have callable and puttable bonds. Callable bonds are like when whenever the issuer issue this kind of bond, they have an option that they can redeem these bonds before maturity. Okay, when and reverse happen when it is puttable bonds. So in case of puttable bonds, they give the bond holder the option to sell the bonds back to the issuer before maturity. Why it happens? It happens it is beneficial sometimes for corporation in terms of callable bonds, because when they see, okay, interest rate is going down, they can just redeem the bonds, and now they can issue fresh bonds, or they can raise fresh money with the low interest rate. Similarly, in the case of puttable bonds, you have option that you can redeem whenever you want your bond. So if you think that interest rate is rising in the economy, you can do, you can just redeem your bonds, and now you can buy other bonds which are paying more higher rate, interest rate of return. Okay. Now we have debentures. So debentures is almost, as I said that time also, generally are they are not secured by collateral. That's the only difference between them and bond. But do not pay much attention to this. They are actually interchangeable, and people just sometimes get confused with this. So don't confuse. It is like just bond only. Then we have sovereign and government bonds that we have discussed already. Okay. Then other kind of product, these are just more recent, and junk bonds. Then we have floating rate notes. Inflation linked bonds is little bit important and getting attention, because these kind of bonds are track the inflation in the economy, and will try to pay you or compensate you based on the inflation index in the economy. Then we have perpetual bond. There's no maturity, as the name suggests. There's no maturity. They will keep going and all. And then we have zero coupon bonds, which has no fixed payment and all, periodic interest payment, but they will be issued at deep discount to their face value, and will be paid at the face value at the time of maturity. Okay, so the difference between the issue price and the actual price, or the maturity price, would be your benefit. Okay, I think here we went to the website of NSC and BSC, where we wanted to see like where I showed the types of corporate bonds are available, and government bonds are available. How can you go and access the information, which segment you go? So nothing, there's an NSC and BSc, you already know the website. You just scroll the website. There would be a segment called markets. Under market, you can see fixed income securities. If you click the fixed income securities, you will have all the information about the company who is issuing debt, how many corporate bonds they have issued, If you click on that particular bond, you can get all the information. What is the coupon rate of that bond? What is the historical trading price of that bond, and what is the rating, and so on. Similarly on BSC also. So both website you can go and scroll, and the in that class we actually went ahead also. We actually did this. So you can do, it's nothing, not a like rocket science. Just go and scroll the website. You will get all the information there. Okay. Now coming to the who regulate the fixed income securities. So we discussed there are two parties. Like is first is SEBI, Security and Exchange Board of India, and the other is Reserve Bank of India. So whenever it's come to all the money aspect and all, Reserve Bank role will always be there. That's why Reserve Bank in interfered when it came to Paytm payment banks also. Whenever Kotak Mahindra Bank also, I think they issued some kind of warning that you are not taking certain measures which could be harmful or dangerous for the investors protection when it comes to online payment and all. Similarly, in the case of Paytm Bank also, they took they do intervene actually. So whenever this money aspect is there, Reserve Bank of India will have its role to protect the interest of the investors. The SEBI role is generally go with the primary issuance, and then secondary market trading also SEBI handles. They brought certain rules, regulations to ensure the fair trading and to protect the interest of the investors. Then credit rating agency also they handle, which provide the rating to the various instruments. Then disclosure and listing also they will handle, and they will yeah, and then they will ultimately ensure the protection of the interest. So they both the agency actually works in the best interest of the investors and try to protect as much as possible. So Reserve Bank actually, the government securities issue and all is mostly handled by mostly not only handled by Reserve Bank of India. They issue securities on behalf of government and pay the payment to the government. Okay, then they are responsible for monetary policy. You might have heard every time, okay, Shaktikanta Das announced monetary policy, and generally it happens bi-monthly. After every 2 months, they come up with certain rates, repo rates, bank rate, and all. So they all comes under monetary policy, which Reserve Bank ensures. They also handle foreign investment. So overall, as I said, whenever money aspect is there, Reserve Bank of India will always have its role. Okay. Now, we discussed about different theoretical framework based on which we supported the development of corporate bond market. It could be signaling theory, pecking order theory, and agency theory. So the development of bond market, or either corporate bond or sovereign bond, can be viewed like from the lens of these theories. So theories are always important actually, because theories are not just built overnight or someone came and they just said, okay, this is the theory. Theory means that it has been well studied and well presented and well accepted, and then they came up with some kind of generalization which they are making about a particular phenomena. So coming to like fixed income security, why I'm saying we can view it from signaling theory, because signaling theory means like it is giving some kind of signal. So whenever a company issues fixed income securities, sometimes it gives positive signal. It may give negative signal, I'm not saying, but generally it gives positive signal that in firms are having sufficient resources and their growth potential is high. It means that they can uh, their growth potential high, mean they can pay their obligation, and if they can pay their obligation, definitely you can go ahead with this kind of companies because your fund is safe. So this is the aspect of signaling theory in terms of fixed income market. Then packing order theory says that financing happens in sequences. Like it should firms should go for debt even before equity. They should first go for retained earning of their own resources, and then they should go for debt, and then only they should go for equity. Why they should go debt before equity? Because they will have certain advantages where the firm will have some kind of tax advantage, like we know that it is tax deductible, and for investor they will have definitely fixed income, and especially it became more important the in emerging economies like India and other emerging economies like Brazil and Malaysia, Taiwan, and sorry, Malaysia and Indonesia and so on. Then we have agency theory. Agency theory, like it separate the relationship between the agency or their representative, like the principal and the agent. like principal, the shareholders, whereas the agent are the other firms. So when firms want to retain, they don't want to dilute the share, or they don't want to uh, divide the ownership and all, they generally go with the fixed income securities, because in that case they don't need to share their ownership. But reverse may happen when they are more like comfortable with equity and all. Okay, so these were the theoretical framework which we generally discuss when we talk about any market and all. Yeah, but fixed income security is also not free from challenges. Like the main challenge is the interest rate risk. Like you might have heard so many times, interest rate fluctuation is happening, and when interest rate fluctuation happens, it puts your money at risk. Like suppose interest rate is going down, you may have invested, or interest rate is going high. You might have invested in the security which is paying low interest rate, and you want to invest in the security which may pay you high interest. Okay, then second is credit risk, meaning default risk. The person you have paid, you have given loan to, or the company you have given loan to, suppose it's not able to pay its obligation on time and it goes on default, what will happen? You will lose your money. Okay, so the second is, these two risks are the most important actually, interest rate risk and credit risk. We will discuss at the end of this. I think last unit is about default risk and credit risk only. Then you have liquidity risk. Liquidity risk in the sense that once you have bought a security, suppose you have bought a corporate bond today, but tomorrow you need money and you want to sell it right now. Like in case of equity, it is very easy. You go to some website, Zerodha or Share Khan, you go to these apps and all, you can happily buy and sell within a day. But suppose this liquidity is not, this is called liquidity, the quick ability of an asset to get converted into cash. Okay, but suppose you have bond and you are not able to sell it, you need money right now for your personal emergency or whatever, so what will happen? You may not like it. So generally it is said when liquidity is high, investors are even willing to take less premium, because at least somewhere it is being getting compensated. What is the point if you have bought something, like it is like you have bought a land, and at that land you cannot just go in the market and sell it and get the money. You need to have time, or the people, or all these things will, it requires a lot of effort actually. So fixed income security will become more important if the liquidity risk is less. Okay, then as I said, there are so many structured products are coming, CDOs, ABS, MBS, and all these things. They make things more complicated because not everyone can understand them. Okay, then we have regulation and market structure. If the regulation is not strong, if the market structure is not in such a way that it can provide an alternative source of finance when financial system is under strain, it will be very difficult, okay, to for a market to be nurtured. Okay, then we saw some low yield environment, like when the required return from the fixed income securities is not as much as it should be, or it is compensating for all your requirements. We call it low yield environment and all. Then we have inflation risk, which we are seeing in the last 2 3 years, particularly after COVID-19 pandemic, that economies are facing high inflation kind of situation. Like from US, then UK even went to recession kind of thing. Now I think they are saying they have a recovery sign now. US also faced high inflation, and that's why they were continuously increasing the interest rate, because if they'll increase the interest rate, then it may put some kind of hold on the spending activities and all, and inflation should go down. Then, and India also is facing inflation, where that's why even if you want to put your money into saving bank, you will not recover actually your actual money also after 1 year. So suppose saving bank is paying you 3% interest rate, but inflation rate itself is 5 to 6%. So anyway, you are losing 3% of your money. No, so that is also you have to take care. And fixed income securities are more vulnerable when it's come to inflation risk. Then we have geopolitical and economic risk, or we can say sometime crisis, which you all are aware very well what is going on geopolitically. Like for example, we saw Russia-Ukraine war is happening, which disturbed the entire supply chain. Then we are seeing this Middle East crisis and all also. So these kind of risk actually affect in the fixed income markets also. Generally, these when economic or political crisis happen, is just fixed income market is not just an exception. It affects the equity market, or it affects social and political aspects of human life. Okay, So these kind of challenges are there when it comes to fixed income markets. And now let's discuss how this crisis happened and what happened recently. So we discussed two cases here. One was Russia's sovereign debt default, and then when Evergrande Group's debt crisis, a Chinese company in the retail sector. So Russia's sovereign debt default, I told you that day that given this war kind of situation with Ukraine, the European Union and other economies, Western countries, they put certain sanction on Russia. So what happened? They had to make €2 bond payments of around 640 million US dollar. That was just an interest payment. But how will you pay in dollar when your money has been blocked? Or like there's a sanction, you cannot use that money. So it's not like Russia did not have money. Only thing is because of sanction, they could not access that money. So if they could not access that money, they could not pay the interest and they went on default. And just out of formality, they gave them a grace period. It is a time when generally the other party gives you a time, okay, within a particular time period, if you pay, suppose you went on a default and you are not able to pay on time, we are giving you 30 or 40 days time that within that time period you can pay. So we'll not put any penalty or you don't need to pay higher interest rate and all. So similarly, they gave this time to Russia also, like 30 days grace period they gave. But what is the point? Like the money was already banned there, so they could not pay during that grace period time also, and they went on default. And there was a revolution happened in 1917 Russia. I think that Mussolini took over the power. That time only Russia faced this kind of default. After that, there was no default in Russian history, at least this kind of default. And this was the first default after 1917. So what happened? There are always a concerns or always consequences when this kind of things happen, that your credit ability or your reputation goes down, and in future if you want to access loan or you want to take money from someone, it will definitely hurt it, and you will either get at higher cost, or you may not even get it. Like it's like your credit score, CIBIL score. I don't know how many of you know this, or how many. Definitely those who are doing job or having credit card and all these things, they definitely may know this. But CIBIL score is like your kind of score based on which they rank you, that whether your ability to pay and all these things. So it's like that only. Then we had this Evergrande Group debt crisis, which recently happened. So they also faced this. See, that's why I was saying liquidity is also one of the important aspect. They also had this liquidity issue, and because of that, they missed some payment. And their payment was also not a small amount. It's a 300 billion. If you take the in 2008, I think. Ireland entire economy was I think 13 billions only. So imagine 300 billions. How what is the big amount it is? So they missed interest payment of it. And what happened then when and this is always a debt trap. When you start missing one payment, it will lead to missing other payments as well. So they started missing other big payments also, and then finally they went to the investors and said, okay, give us some time, or we want to restructure in the sense sometimes they try to change the condition of the loan. Either you reduce the interest payment, or you just partially give us a waiver, or give us some more time and all. So this kind of request they raised, but I don't know how much it worked. But this definitely increased the concern regarding the contagion risk meaning, like when risk happen in one economy or one particular company or one particular market, there are chances that this risk may spill over to other markets. So like for example, the retail sector faced a huge setback after this Evergrande crisis. And if retail sector is going down, definitely see there are so many sectors which are associated with it. You have cement industry, you have they need iron, they need other kind of resources. They need, so one sector is getting affected, all the associated sectors around it will be affected. So if retail sector is not getting money, the bank other sectors may also be affected. Bank is not recovering its money from them, so they cannot give then or provide money to other sectors also. So that's why we call it contagion risk, like risk in one economy or market is being spreaded to other economies or markets, and this kind of risk happens. So it may actually sometimes uh, like kickstart the entire recession kind of situation, or may entire economy may go as insolvent. Okay, so this kind of risk happen when this. So that's what the purpose of discussing these two crises, like to tell you what happens actually, that fixed income security is also not from is not also risk free. and this kind of situation may come up. In India also we had this IL and FS. I shared one newspaper article also. They might have read, and those who did not read, and definitely every time you see the news and all this kind of news will come and you can read all these things. Okay, and I will again share today also, you can read that. Okay, then recently this is about particularly emerging markets, like why emerging market goes on default. They goes on default because they have their challenges. They have their, first of all, fundamental challenges like education, market structure, and the basic requirements. They need to put money on certain very hygiene things and all also, which sometimes take a lot of money. They have to borrow because their resources are limited. They have limited money. They borrow from other economies. They borrow from their own people and all. But since they have less money, or that money is not sometimes not being utilized effectively or not providing the return as expected, the debt burden will keep increasing and increasing, and if it is increasing more, definitely it would be difficult for them to repay the debt. And this will be the situation happen what China's this Evergrande was doing. They will again start asking restructuring, or either they will go on default. Okay, so this kind of situation are more common in emerging economies. That's why whenever we talk about yield, the yield on the bonds will always be higher on the bonds issued by a company operating in an emerging economy. Okay, that's why in India, corporate bond offers up to 10%, 11%, but you see the company in US, the interest rate would be around 1%, 2%, or 3%. That's why foreign parts, it is all, it works as a positive in a positive manner also sometimes, like we attract a lot of FPIs or other kind of money. They want to invest in India because they are getting better return. Okay, so this kind of situation, like given their weak fundamental institution and all, sometimes the economies or companies in emerging economies are high chances they may go on default. But this is not always true. It's not like companies in the developed economies are not going on default. There are so many cases where the situation is reversed. Okay, then coming to the regulatory reforms, in recent year, India took so many reforms to boost the retail trading, or to encourage or promote the development of bond market per se. Like some of the reforms I discussed that time, like even now you can open your account with RBI under RBI Retail Direct, where you can directly invest in government securities such as T-bills or cash management bills and state development loans. You just have to open your account and just you can start. It is very well available. You just go on the Google and just type RBI Retail Direct. It will take you, the URL will take you to that website. Now they have also reduced the minimum investment requirement. Hello, someone say. Okay, so now they have reduced the minimum investment requirement also. Now I think earlier it used to be 10 lakhs or something, but now it is just 1 lakh or something you can start your investment with. Then we have online board platform regulations is coming in future. Then we have limited number of ISINs. Like if you have so many ISINs, it may be confusing or sometimes so they are clubbing them, and the liquidity will be higher given that. The last section of this unit was, I think, let me see how many. Okay, yeah. Then we started discussing about how interest rate are determined. So first of all, we discuss about what is repo rate. This is the benchmark rate set by RBI. The rate at which RBI lends short-term funds to the commercial bank through repurchase agreement. Banks borrow from the RBI to meet their short-term liquidity needs. Okay. But apart from repo rate, you have monetary policy committee, which actually regulate all these things and recommend RBI what is happening in the economy and how should they set the repo rate. So what MPC do? MPC takes certain factors into account before giving recommendation regarding what should be the repo rate and all. The first is like this first thing, what is the inflation rate in the economy, or what is RBI is keeping as a target of the inflation. Okay, once they have done with this, they go with the economic growth target. They consider what is the state of the economy right now, and then what is the growth we are expecting, and accordingly they adjust rate to promote the growth. Okay, then they consider the liquidity, like what is the money supply in the economy. The level is measured by M1, M2, M3 kind of measures we have. So they try to measure the money supply situation in the economy, and accordingly they give their recommendation. Once they have done that, the RBI set a repo rate and tells the bank, this is the rate I am willing to lend you the money. Okay, so once it is set, what will happen? Commercial bank, there's no such rate that RBI will tell them this is the rate you should charge from the borrower, from your borrowers. But they just tell this repo rate, and that what commercial bank do, they adjust certain their margins and put this rate on the head of ultimately depositors. Okay, so this works them as a reference point for the commercial banks also. So suppose RBI set repo rate as 4%, they will put their margin, or now we call it MCLR. Based on that, they will put little bit extra on that, and they will charge it from you. Okay, so that's why whenever they say, okay, repo is increasing, people start paying attention. Oh, what is happening? We are also going to get going to take loan or at a higher rate. So some for us it may not matter much, because the if it goes from 4.5% to 4.75%, you say, oh, what is there in 0.25%? But suppose those who are borrowing in terms of billions and millions, for them it matters a lot. Okay, so a small change can make a big difference. Okay, then there are other market factors they consider, such as what is the demand and supply of loanable funds, what is the credit risk kind of situation in the economy. Okay, whether the risk is increasing, whether the credit spread is increasing or not, and accordingly they set up the repo rate. Okay. Now the question is how much a bank can charge then. Then I told you in the previous slide also that they take repo rate as a reference point. From there, they add a little bit margin from their side. Earlier, it used to be base rate system where the rate was fixed, and they used to take this rate as a reference rate and put this on the depositor's head. But now they have a more sophisticated measures such as marginal cost of fund-based lending rate, in which what do they do? They see what is the extra cost they are going to incur for a 1 unit of extra loan and all, and accordingly they calculate that margin based on what is their operating expenses, what is the negative carry on SCR. Negative carry in the sense the CRR doesn't pay any interest to them. So they consider that also. That is kind of opportunity cost for them. So they consider all these factors, and then they charge a minimum in lending rates based on which they will provide you the money. And this was the example scenario we measured, like in a hypothetical world. So suppose that inflation rate is 6.5%, and which is just above the RBI rate range. RBI range is like targeted range is 2 to 6%, but it is 6.5%. Then MPC will consider economic growth that the target should be 7 to 8%, but it is going like 6%. Then what is the liquidity situation? What are the global factors, like what is happening in the economic environment of US? What is happening? What central banks across the world are taking decisions and all? All these factors MPC will consider, and then accordingly they will make their decisions. That this is just a like what inference they will come with. If inflation concern is there, they cannot put a low interest rate because they need to correct the inflation, so higher interest rate will control the inflation. Then they will consider again economic growth and then liquidity and global impact, and then they will say, okay, we are coming up with certain decisions. Like, okay, after considering all these decisions, we decided that this time the repo rate will be increased by 0.25%, meaning that inflation is a major concern right now, it means in the economy, and they came up with a decision like all things remain constant, but we need to control inflation also. And considering all the factors like pros and cons, we are coming up that this month or for this monetary policy, we should reduce we should sorry we should increase the interest rate, okay, from 6.25%, 6.5%. These are hypothetical value. I'm not telling this is the ongoing situation in the economy, but it will trigger certain consequences. What that lending rates will become, because definitely bank is not going to take it by its own. No, they will bypass it to you. So definitely lending rates will also increase, and now instead of 8.5%, they may charge 8.75%. The same proportion they may increase the rate at which they will provide the loan to you. So borrowing cost definitely it will be higher for you, and same way, but advantage would be that even deposit rates will be higher. But as I said, sometimes like current rate and all, or this saving rates and all may not be as sufficient to cover your inflation and all. Impact on inflation, definitely inflation should go down because now interest rates are high, the credit will get a halt, and it may reduce the purchasing power or overall economic money growth in the economy. Okay, so economic growth, it may definitely can slow down the investment and consumption because you will have lesser money to spend, given the higher interest rate, and sometimes it may but trigger the currency stability, like your market will become more attractive for the foreign participants because you are providing them higher return. Okay, so with this, we covered this first unit quickly. So I'm little bit sorry here because you must be thinking I'm going bit fast, but there are so many things to cover, and we have to cover this 2 to 3 more units in next 3 to 4, 2 to 3. Sorry.
हेलो
In
सर
next 2 to, tell me. Wait a second. Wait. Just tell me.
सर
Yeah, tell me.
सर एग्जाम पॉइंट ऑफ व्यू से रिगार्डिंग न्यूमेरिकल्स कौन से इम्पोर्टेंट रहेंगे?
See, now numerical will be start like so your exam would be both theory and numerical. So it would be 50-50, or it could be even sometimes 60% theory, 40% numericals. So but consider it would be 50-50. So they specifically emphasized on that. Just note theory should not be the only case. Oh, sorry, numerical should not be the only case. You should have understanding of theory also. That's why I spent entire 1 hour to discuss this introduction section also. Okay, so it would be
सर
50-50.
न्यूमेरिकल से कुछ टॉपिक डिस्कस कर सकते हैं आप?
दिक्कत कर सकते हैं मतलब?
डिस्कस कर सकते हैं न्यूमेरिकल
अच्छा,
से
हाँ
कुछ टॉपिक?
हाँ, अब next session we will discuss about numericals. Okay, so one unit is over. Next unit would be about bond valuation and bond pricing. दे कुछ न्यूमेरिकल्स होंगे वहाँ पे, आप उसको सॉल्व भी करना बैठ के आराम से. सो नेक्स्ट यूनिट वुड बी अबाउट दिस थिंग ओनली. ठीक है.
सर और कौन से टॉपिक है न्यूमेरिकल से?
मोस्टली बॉन्ड वैल्यूएशन है, मॉडिफाइड ड्यूरेशन होगा, आपका कन्वेक्सिटी है, फिर वॉलेटिलिटी हमने निकाला था, फिर हमने वैल्यू एट रिस्क निकाला था. आ, और हाँ, यही कुछ चीज थे. एक्सेल सीट भी है मेरे पास, क्या क्या निकाला था.
ओके सर.
हाँ, we have this gap analysis, war analysis and all we will discuss, okay, down the line. So you guys were continuously listening. I was a bit fast. Just give me 5 minutes break. I'll take little bit water and then we will discuss. We'll start around
Sure.
6:16. Okay.
Okay, sir.
Thank you for being considerate. Like I'll just get some water and then we will discuss around 6:15. Is it okay?
Okay.
Okay. Thank you.
Yes. Sir, 6:15 or?
6:11 only, no? So 4-5 minutes break only I'll take. It is too much?
No. I was confused. You were saying 6:50 or 15.
15. Just 5 minutes break. Okay. I'll take it. I'll
Okay.
get some water and then come. Um, Hello everyone, welcome back. So now we will discuss unit 2. And okay, this unit will have like bond valuation thing, and also we will have numericals also. We will discuss some numericals. Uh, just let me know, Bhavna, once my screen is visible.
Yes, sir.
Okay. So unit 2 starts with the bond pricing and calculation of returns. It's not moving. Okay, it's moving. So it's about bond value. What is bond value? So bond value is nothing but is the present worth of the market price of a bond, representing the amount an investor would need to pay to acquire the bond in the secondary market. So in a common sense, like whatever the amount right now you need, or what is the current value of a bond at which you can just share and trade this in the market, is called your bond value. What is the worth of the security or the bond you are going to invest in? Okay. And valuation is nothing, it's the process of finding that worth. Okay. So valuation is the process of determining the fair market price or value of a bond. Okay. But bond value had different components also. These components are very important when you are discussing about bond valuation. So these are very common, which we discussed in the first slide also. It should have a face value, coupon rate, time to maturity, and most important, yield to maturity, or required rate on return, or market rate of return. Okay, so this there's a separate section dedicated to yield to maturity. We will discuss it that time also. So this is the formula. Please note down right now this formula. We will have 3-4 numerical questions that I will ask you guys to solve. Okay, Bhavna and Atul, you have already solved this question, so you don't need to solve, but remaining class will definitely solve it. Okay. And so formula, please write down right now. So bond value can has two separate things. So it's a combination of two components. One, it is the present value of all the future coupon you are going to get in receive in futures, plus the present value of your principal payments. Okay, so this is the formula. Either you can calculate the present value of all the cash flow like this: coupon 1 divided by 1 plus r power n, coupon 2 divided by 1 plus r power 2, or you can use present value annuity formula, because if the coupon rate is consistent, you can have the second formula also, where you can just write it coupon multiplied by 1 minus 1 divided by 1 plus r power t divided by r, plus the second component, which is the present value of your principal payment you are going to get in the future. So as I said, there are two subcomponents of bond value. The first is the present value of all the cash flow you are going to receive in the future in the form of coupon, plus the redemption value or the face value you are going to get at the end of maturity period. So suppose you invested 1,000 rupees. In case of fixed income security, at the end of maturity, you will get your principal back. So you have to calculate the present value of that principal amount also. Okay, so right now, please write down this formula, and not like it would be difficult for me to come back to this slide again. So right now, write down, and these kind of questions will definitely help you in your exam, and definitely high chances that questions from bond valuation will definitely come, because this is the base of fixed income securities. Okay, so this is the formula where C is the coupon, R is the yield to maturity or required rate of return or internal rate of return or market rate of return. You can call it with so many names. F is the face value or the par value of the bond expressed in terms of either dollars, or in case of Indian currency, it is INR. T is the number of years or the time until the bonds is going to mature. Okay. So let's start with a simple example. As I said, there are two components of current price of the bond. So suppose there is a company called ABDC, whatever, it has 10 years to maturity, which for a bond it has issued recently. The coupon payment is $80, like, so and it means that it will pay $80 per year for the next 10 years in the form of coupon. Okay. Apart from that, suppose the bond price was 1,000, or at the end of maturity, you will get this 1,000 rupees back. Okay, so this is the graph. It will start with time 0. At the end of time 1, you will get 80, then 80, 80, 80 up to 9, and then 10 years. And at the end of 10 years, you will get your principal also. Assuming now the market rate of return or yield to maturity. So in the beginning, you will have the information. in the beginning, we are assuming we know that this yield is known or the market rate of return is known or yield to maturity is known. But there are situations we don't know this, that we will discuss in upcoming slide when we will discuss about yield to maturity, how to calculate this market rate of return. So for the time being, just consider you know this that yield is given, right? 8% or 10% and 9%. So as I said, what will you do? You first estimate the market value of the bond by calculating, listen very carefully, by calculating the present value of two components separately and adding the results together. So first you will go with the coupon payment. So you can go with this principal payment also, coupon payments also, it's up to you. So let's see at the going rate of 8%, the present value of $1,000, or I will call it rupees also, paid in 10 years is present value formula. As I said, it is, we call it sometimes present value factor also. The 1000 divided by 1.08 power 10. 8 is the coupon a market interest rate and 10 is the maturity period. That's how you will calculate the present value. It is around 463.19. Now you will calculate the present value of all the future cash flows you are going to receive in the form of coupon. Okay, so coupon payment you have, the formula you will use C into 1 minus 1 divided by 1 plus R power T divided by R. So 1 minus 1 divided by 1.08 power by its maturity, which is T, is 10 divided by 0.08. Or you can directly go in the table form. You can go in at the back of your book and you can see what is the present value annuity factor for the 8% at 8% of interest rate for 10 years. They will directly may give you like 6.71 or something. You multiply it with the future the component, the coupon payment, and you will get your present value of your all the future of cash flows, which is 536. Simply just add these two, you will have your present value. Now you can see that it is 1000 equal to the maturity value, the face value. Why? Because the coupon rate and market rate of return both are same. The coupon was 80, 80 of 1000 is 80. No, sorry, 10%. No, sorry, 8%, and 8% is your market rate of return. So the bond value will be equal to your market value, or the market value will be equal to your face value or the maturity value. Okay. Now take the second example, but what happens if the interest rate change and suppose that year has gone by. So read this numerical. The numerical is the ABC bond now has 9 years to maturity. Earlier it has 10 years. If the interest rate in the market has increased up to 10%, what will be the bond price, or what will be the bond worth, or what will be the bond value? So to find out, we will repeat the same present value calculation, but this time we will repeat it for 9 years instead of 10. And 10% yield, this time we will have instead of 8%. Okay, so here, as I told you, or if you remember, or you might have read in the SAPM course also, there's always an inverse relationship between interest rate and the market price. Okay, so now interest rate has increased up to 10%, so definitely the market price should be less than 1000. So let's calculate, and we have calculated also the 1000 divided by 1.10. First, the principal amount, we brought the present value of the principal amount and it is become 424.10. Now second, we have coupon payments and we will calculate the present value of all the cash flows we are going to receive for next 9 years. And now the amount is 460.72 with the formula which I discussed, 1 C into 1 minus 1 divided by 1 plus R power N and power divided by R. So the market value is now, once you have calculated both the components, the market value is now 884.82. So this is proving the theorem also, that the interest rate and the market price goes in inverse direction. Okay. Now consider the scenario 3. If the interest rate drop by 2%, okay, so now it would be 6%. What will happen? So as I said, we can assume since the relationship is inverse, this time market price should be higher than 1000. Okay, though it is given already, but we can calculate this also. First, same, the present value you have calculated for your maturity price, and in the second component you have calculated the present value of your future cash flows. This time it is 591.89 plus 544.14, and your total bond price or worth or value of your bond is now 1136.03. Okay, so definitely it is higher than your actual price you paid for, like 1000. So this proves the relationship between bond price and interest rate, that which is there's an inverse relationship between the two. Now I was telling about you this only, present value factor, present value annuity factor. This you guys know, most of the
Hello,
people, I think.
sir.
Yes.
Sir, can you repeat the previous question?
Shall I repeat? What should I repeat? Previous example.
Previous, previous question.
The scenario 3.
Yes.
So what scenario 3 is saying? This type, instead of increased in the return, rate of return, the rate of return has gone down by 2%. Okay. So just always remember, which we have been said, which we have discussed so many times, there's always an inverse relationship between interest rate and the market price. Okay. So the if there's an inverse relationship, the interest rate was 8% and it is going down to 6%, the market price should go up. Okay. So in the numerical example, we calculated this also. First, we calculated the present value of your maturity price. Your maturity price is 1000. You have divided it by 1.06, which is your interest rate right now, powered by 9, which is the maturity period. And that's how you have calculated the present value of your principal payment, which is 591.89. Now, in the second step, you will calculate the present value of your coupon stream or coupon cash flows. So you have cash flows of 80 rupees per year, that too for 9 years at the rate of 6%. So you will use the another formula, which is like I said, coupon rate multiplied by 1 minus 1 divided by 1 plus R power n divided by R. So 80 into 1 minus 1 divided by 1.06 power n divided by 0.06, and that's how you will calculate your present value of your all the annuity you are going to receive in future. So that is your 544.14. Once you add both the components, which is present value of the coupon plus present value of the face amount, you will have your bond price, which is 1136.03. Is it okay now?
Yes, sir.
Hmm.
Thank you.
So as I said, instead of using that formula, you can directly use the present value factor also. But sometimes what happens when you use present value factor, you may not get the exact rate of return in that table. So suppose the rate is 8.7345%. What will you do? They generally gives you what to say, discrete value like 1%, 2%, 3%, 5%, but may not give the continuous value. I don't know if they give, but as far as I know, they don't give actually. But still you should have some knowledge of it, or that's why that formula is useful. No, that formula is doing nothing, but they are calculating the present value factor, present value annuity factor. Okay, so no need to look into table. That's why I always say just go with the formula. You don't need to look into the table. So the present value factor is handy when we have only one single future cash flow, which is generally about is our principal payment, like 1000 rupees in our case it was. Present value annuity factor is comes when you have annuity. Annuity in the sense you have continuous payment for next 5, 10 years, 6 years for your, like there's a series of equal periodic cash flows. Okay, then in that case we take present value annuity factor table. And this is like, as I said, the formula is also same, or sometimes they give the calculated value. You just have to multiply with that factor to your cash flows and you will have your present value. Okay. Now we have example of zero coupon. So zero coupon, as I said, are the bonds we do not pay periodic cash flows. So if you don't have periodic cash flows, what will you do? You still have to calculate the value. So in that case, the simple thing is, in zero coupon bond, you divide the price, or the price you are going to you bought it or you are paying, just divide it by the YTM. So suppose there's a 15-year zero coupon bond which you have paid 1000 rupees, or which will pay you 1000 rupees back at the time of maturity. What should be its market price? So the 1000 divided by 1 plus 0.06 divided by 2. Just please remember, why did I 2 divided by 2? Because it is semi-annual. Okay. When semi-annual payment is there, you have to do two things. The interest payment you have to divide it by 2, because it will become now this thing 6% is annual. For 6% you will make it 6 monthly. You will divide it by 2. That's it. 2 periods are there in the 1 year, 6 months, and you will make the maturity period twice of it. So there are 15 years, but you have semi-annual payment. 15 into 2, there would be 30 payment periods now. So whenever it comes semi-annual, you have to do two things: interest rate divided by 2, and whatever your terms or maturity and all, just multiply it by 2. Okay, so in this first scenario, we have 6%. So we calculated 1000 divided by 1 plus 0.06 divided by 2 power 30. It has 411. Scenario 2, we had 8%, same thing. And scenario 3, we had 10%. And we had this market price for the zero coupon bond. So as the interest rate is increasing, market price was going down. So zero coupon bond are the easiest one to calculate the market price. You don't have to do anything. Just divide the price given by the YTM. Okay. Now you have non-zero coupon payments. Okay, so now you have to calculate. Okay. Just note down this example and please calculate the value. Or do one thing, I'll solve it, I'll give you another example. So, okay, let's discuss this also. I'm taking it as an example, so questions would be different. So, okay, let's discuss this. I'll only discuss it. So the value is 1000. The par price or the face value is 1000. Time to maturity is 20 years. Coupon rates 7%. Semi-annual payment. If semi-annual payment, coupon payment will become 7% divided by 2, 3.5, and time to maturity will become 20 into 2, 40. Okay, now you have to calculate the bond price if the YTM is given 3, 7%, 9%, and 5%. Okay, and this is the solution. So the price of any bond is the present value of interest payments, as I told you, plus the present value of your par value. Okay, always remember this. There are always the two components. What happens? We all know. You can also say, "Arey sir, we know already this. Why are you telling this?" But I'm telling you, sometimes in the class people miss this. What do? They just calculate the present value of coupon payments and that's it. They forget the second component. That's why I'm specifically focusing on. Just always remember when you are going to calculate the present value, it is the like combination of two things: the present value of your par value and present value of your interest payments or coupon payments. Okay, so the in first case we had 7%. So as I said, same formula for the subcomponents 1 and the for subcomponents 2. Add the value together, you have price as 1000. Why 1000? Because 7% coupon rate is equal to the 7% market interest rate. Now the interest rate goes to 9%. Same formula, the price is now 815. Okay, in the third case, the coupon is 5%, goes down. Same formula for the coupon interest payment and for the par value. Add both these together, you have 1251.03. Okay, so this is based on this example. Now I will give you 4 numericals and please calculate this in next 1, 2, 3, 4, 4, and 3 to 12. Okay, take 12 minutes. Because things are simple. If you have formula already, you have calculator, you have. If you don't have calculator, use your Excel and try to do calculation and all, and solve all these 4 questions from your side. If I solve it, there is nothing. It's not going to solve any purpose. Revision class, you also have some revision. Okay, so solve this 4 questions next 12 to 13 minutes, and I will come back. Just I'm making myself silent for some like mute for some time, and the screen will be here only. Here it is. Okay, so after this I will share the screen. Bhavna, you just tell me whether the screen is visible because I'm just keeping myself on mute and sharing the screen. Okay.
Okay. It is visible.
So I will come back around 6:45. I will start this class again. By the time, please solve these questions.
सर क्वेश्चन हट गए हैं.
Sorry.
हेलो सर,
Yes.
क्वेश्चन हट गए हैं स्लाइड.
हाँ हाँ, आ रहा हूँ भैया. वो म्यूट करने के लिए आना पड़ता है, अनम्यूट करने के लिए आना पड़ता है. बार बार करता हूँ.
It is visible.
छत खुली हुई थी। हम्म। दरवाजे तो भिड़े हुए थे लेकिन छत खुली लगी थी। वो तो मेरे को आज याद आ गया, मैंने चला गया। आज नहीं गया हूँ। हम्म। यहाँ शायद नहीं, बाहर से जा रहा हूँ। उधर आता होगा, वो मेन गली है ना, वो मेन गली है। हाँ, वहाँ वहाँ कई भाई आते हैं।
Harshit, can you mute yourself?
हेलो, वेलकम बैक। सॉल्व हुआ? प्लीज जिसका सॉल्व हुआ आंसर बता दो। हेलो, व्हाट इज द आंसर फॉर फर्स्ट क्वेश्चन? व्हाट इज द बॉन्ड प्राइस? एनीवन? गरिमा, मनीष, अभिषेक, ध्रुव, हिमांशु, हर्षित, सॉल्व
सर
किया आप लोगों?
1067,
हाँ, करेक्ट,
1067.201।
परफेक्ट, सही है। सेकंड का किया? Did you do for second?
सर 1 सेकेंड।
Anyone else can tell, no? If they try to solve. Okay, then I'll just continue the class. Then I don't think so anyone else solved it. Okay, then I'll continue the class. These are the 4 questions. You try to solve it by yourself. If you haven't solved yet, you can solve it later also. Okay. My screen is visible again, right?
The second question
Yeah.
का आंसर
क्या है आंसर बताओ?
3378
It should be around
0.03
4391, I think.
4391.
It's a
Okay.
zero coupon bond, no? Just 10,000 divided by 1 plus 0.049 divided by 2 and 17 into 2. So it's a semi-annual. So 17 into 2, 34 your maturity period would be there. And your coupon payment would become 0.49 divided by 2. 0.49 divided by 2. Okay. So solve it like this only. Yeah, but good, like you tried well. Your first answer was also correct. Second also tried well. Good job. Now I will continue the class and you can also solve these two questions later on. Okay. Who was it? Like who answered the question? Sorry, I can Dhruv or who?
Excuse me,
Harshit.
sir.
Harshit, you saw the question, no?
Yes, sir.
Good job, Harshit.
सर इसमें डॉलर प्राइस पूछा है सर. डॉलर प्राइस कैसे निकालना, मल्टीप्लाई करके?
No, just a sign. Consider it INR. Don't worry.
Okay.
Just a sign. Okay. So generally, bond market is very famous in US actually. So their bond market is like as liquid as equity market in India. So generally, people and we follow the foreign books and also they have this sign only. So that's why I never say you have to convert it. Just let it be like this only. If it is dollar, it is dollar. If it's not dollar, just consider it INR. Okay.
Okay.
Okay. Now once we have like now this, please solve these questions. I'm pretty sure from bond valuation and all you will get some questions in your exam also. And they may not give the simple question, they may like club 2 3 things together and can give you. So if you solve all these 4 questions, they can like capture most of the aspects of all those kind of questions. So try to solve these questions by yourself. Now coming to the bond price theorems. What are bond price theorems? So these theorems actually try to
Excuse me, sir.
establish the yes.
सर आप आज कौन से टॉपिक कवर कराएंगे?
मैं भैया ये इस रिवीजन क्लास, so I will try to cover entire like all 3 4 units.
Okay.
Okay, so it's the second unit. After that we will start with third unit, and then fourth I think
सर
one of this is yes.
सर मॉडिफाइड ड्यूरेशन पे क्वेश्चन करेंगे हम?
हाँ करेंगे करेंगे करेंगे.
Okay.
ठीक है. Okay, so bond price theorem, just is a theory you can read by yourself to try to establish the relationship between bond price and with its yield, with price volatility, time volatility, how these factors play its roles. Okay, so first we have already discussed a lot, like there's always an inverse relationship between bond price and yield. Second is price volatility and time to maturity. This says that the bond price are more sensitive to change in interest rate when the time to maturity is longer, meaning longer term bonds generally exhibit greater price volatility compared to short term bonds in response to change in interest rate. The reason is simple, that long term is more uncertain compared to the short term. Things are not as clear as it is clear in the short term. So and when the period is high, YTM wise also and interest rate wise also, the effects starts magnifying more when when the maturity is more. Okay. Then we have third theorem about coupon effect on price sensitivity, zero coupon bonds and interest rate sensitivity. These theorems I will share the slides with you. These are theories. Please read those. They may ask you in the exam. Tell at least 2 to 3 theorems of the bond price. Okay. So read these. As you can, if you read the slide also, they are more than enough. But for those theorems at least, or otherwise you can do Google also. Okay. So I'll just try to save some time. I'm not going to discuss this. We discussed all this in details and we had some questions answers also regarding that. So you please try to read all these theorems. Okay. Okay. Now coming to the yield. So as of now, we were talking that yield is given or yield to maturity is given. So first of all, what is yield? So yield is refers to the rate of return an investor receives on a fixed income security such as bonds, debentures or certificate of deposits. Okay. So it is generally your return on the fixed income security in simple manner. Okay. It also has the similar components such as coupon rate, par value, maturity rate, and market price. Okay, and in this table, I have given what are the differences between yield and coupon, because sometimes people get confused what that coupon is also a return and yield is also a return. Then what is the difference? So that you can go through these differences. The first example, go with definition wise. Yield is your overall rate of return you earn when you buy a bond and hold it until maturity. So the yield becomes more popular when you go and trade the bond market in the secondary market. Coupon is just a fixed annual interest rate you are going to get when you buy the bond, and you get comes up with a certain terms and condition with the issuer. Okay, this much coupon payment he will pay you. But in the market, the interest rate keeps going up and down, and accordingly, your overall return will also be changed. Like for example, if the bond price when you the issue price is 1,000, but the market price is 1,000, it won't make any difference. But suppose the issue price was 1,000 and now you are going to get it 900. Definitely your return would be not 50 rupees or 10 rupees or whatever the fixed coupon rate. It will be changed. Okay, so that's why the difference becomes more important between yield and coupon when we talk about the trading in the secondary market. And that is not going to be traded, or we are not going to buy and sell it. It doesn't make much sense. Okay, but you have to take care of interest rate when you want to trade your security in the market or buy and sell your security in the market. Okay, so to calculate the yield, it considers coupon also, it considers your purchase price. So as I said, because you are trading in the market, definitely there would be a market price, maturity value and time to maturity. Coupon is just fixed. Okay, yield can have different form, yield to maturity, current yield, yield to call. It's just a one type, coupon. Okay, then your relationship to bond, like coupon don't have direct relationship with the bond market price because it's always fixed. But yield always have an inverse relationship. Okay, then you have importance, value, change, use, all these things you go. These are kind of differences which are basic and common fundamental differences between yield and coupon. So you have to take this into account. Okay, this from theoretical perspective, from your knowledge based perspective. Okay. Now these are the types of yield we were discussing the last slide. A coupon yield. Coupon yield, nothing, just is a coupon payment. Then you have current yield. Current yield is like bond's annual income relative to its current market price. In this, you just divide the coupon by its current market price. Then you have yield to maturity. This become more important when you buy a bond today and you think, okay, you will keep this bond till maturity. The overall return you will calculate for that entire period, you will call it yield to maturity. Then you have yield to call. It becomes like it comes into the picture when you when this in terms of particularly callable bonds, that till the time market the till the time issuer call back the bonds, what would be the total yield? It would be called yield to call. Then worst case scenario, what would be the yield? It would be yield to worst. Then real yield and yield spread. Yield spread is the difference between the different bonds or between a benchmark bond and a bond you are going to invest in. So generally we say the difference between the government corporate bond and the difference between the difference between corporate bond and the government bond is called as the credit spread or yield spread. So suppose corporate bond always pay higher than the government bond because they are slightly riskier than the government bond. So suppose government bond is paying 8%, corporate bond is paying 10%, the 2% would be your yield spread. Okay, now coming to the most important one, which is yield to maturity. As I said, you can see in this picture also. I try to put this picture so that you can have better clarity. It is the overall rate of return, if I say. So suppose in the market you are going to buy a bond today and you are going to hold this bond till maturity. The amount of return, the return you will get on this bond is called your yield to maturity. So if you read it out, it is like YTM is the total return an investor can expect to receive if they hold the bond until its maturity date and reinvest all coupon payments at the YTM rate. YTM takes into account not only the annual coupon payments but also any capital gains or losses that may occur if the bond is bought at a discount or premium to its face value. It is considered a more comprehensive measure of a bond's return than coupon yield or current yield. So this car, you can see this guy bought the bond there, came here, kept the bond with him, and it came to the end of the term. So that he bought there and kept it till maturity. The overall return throughout this journey he earned is called yield to maturity. Okay. Then how to calculate yield? There are two ways, either trial and error method, which you call its iteration method also, where you want to check the exact YTM Or suppose in the shortcut, or you want to see just approximate measure, there is an approximate formula also, and this formula please write it down. We may have some questions on that also. Okay. So F is the face value, P is the market price, N is the number of years, then F is the face value plus P is the price divided by 2. This is the formula, C is the coupon payment. Okay, so write it down. We can solve some question based on this formula also, and we can solve some question on trial and error method also. Let's discuss how to calculate YTM. Okay, so the fundamental is always the how we calculated the bond price. Okay, so in the bond price we thought, okay, R is given or yield to maturity is given, but this is not the case. YTM may not be given, and how we will calculate, this is how we will um, modify the formula, or we will use some trial and error method, and then we will calculate the YTM. So read the example. So suppose an Indian company issue a bond with a par value of 10,000, 8 years to maturity, and a coupon rate of 12% paid annually. There is no semi-annually thing here. If the market is market price is 10,600, sorry, it's not percent, it's price. What is the yield to maturity of the bond? Okay. Okay. So the bond price, as I said, is the component of your present value of future cash flow and the present value of principal. Okay. So you suppose you have what will we do here? So we generally go ahead with the coupon payment. So we will we will assume certain percentage as our YTM, and we'll try to calculate the market price on those rates. Okay, so suppose we assume, okay, there could be 4 YTM, it could be 9%, 10%, 11%, 12%. Which two rates will be more closer to the market price currently, then we will use trial and error method with those two rates, and we'll try to calculate the exact YTM. Listen again. We have all the data is given. This time, instead of YTM, we have been provided with market price. Earlier, we had YTM, but market price was not given. So based on that market price and all, we used to calculate based on that. Sorry, YTM, we used to calculate market price. This time, based on this market price, we will try to calculate our YTM. Okay, so first trial you take with 9%, second trial you take with 10%, third trial you calculate with 11%, and fourth trial you calculated 12%. When we were discussing this last time, I actually asked, like that time, like Atul and all, Bhavna, and I think one more girl was there, Core. I don't know, I forgot her name. They actually literally tried and then told me the value. Okay, so we actually calculated all these things. Once you came up with two rates which are closer to one rate which is just exactly above your market price, and one rate which is just exactly below your market price, which you will take these two rates and then you will calculate the YTM. And what is the formula for that? First, what is the YTM of the price which is just above the market price plus the above price minus the current market price, which is 10,600, divide by the price which was just above the market price minus the price which was just below the market price. This is the formula. If you will calculate this by yourself, which I think I saw in the last slide, like in the previous examples also, except one person, nobody tried. So I don't want to like waste time here to ask you again solve it. So I'm just telling you, that's how you have to calculate the market price. Once you have calculated market price, that YTM formula you will use a trial and error method, and that's with you will come up with the rate which is called YTM. Okay, so suppose your
अरे
rate was, yes,
excuse me sir,
yes.
सर बॉन्ड वैल्यू का फॉर्मूला कहाँ यूज होगा? C into 1 minus 1 upon 1 plus R.
So C into 1 minus 1 divided 1 plus R. R is your assumed YTM, which is 9%. It could be 10%. It could be 11%. It could be 12%. Trial rates. Okay, now you may ask, sir, what
Okay.
trial rate we should take? We are not sure. What can you do? You can take, generally what we do, we take the coupon payment and we go one or two rate above coupon payment, coupon percentage, and one or two rate below coupon percentage. Okay, so suppose it's 12%, just start with 10, 11, and 13, 14. Like this we generally start. Okay, most of the cases generally it works like that only. Nowadays, in if you are solving it in Excel or some advanced software, SPSS, Stata, R, Python, and all, it is not like it doesn't make that difference. It takes only hardly 10 to 15 seconds to sort it out. But you need to understand the basics. That's why there are some trial and error method. You need to know what is the background of this. Okay. So bond value formula you put in one side. You have written it written down it here like bond value C into 1 minus 1 blah blah blah. This is the formula. Now you have everything. You have coupon payment, right? 12%. You have time, which is given 8 years. Okay, you don't have R. You have face value also. And you are trying to calculate this R. So what will you do? You will take assume for 3 to 4 hours YTM will put in this formula. The bond value, whatever will come, you compare it the actual market price. You should calculate at least minimum two market price you will consider the price which is just above this 10,600 and the price which is just below the 10,600. Like at that rate, the market price is just below the 10,600 and if you will change other rate, it will go more. So you have to bring these two types of rate. Then you will put this into trial and error formula and you will have your exact YTM at which your market price would be 10,600. So that is the second purpose of YTM. No, this is the rate at which your current market price will be, like if you discount it will be zero. Like your market price should be 10,600. Okay, so 10,600 minus 10,600 it would be zero. So you will try to calculate at the rate you will calculate with this formula will be the rate. If you put all these things into formula, the market price will come 10,600. Okay, so this is the purpose of calculating a YTM by trial and error method. Second thing you can do, you can just use that this thing approximate formula which I discussed here. Harshit, you just try to do with this approximate formula. What rate you get? Is it around or not? Like C you have already. What is C? It is 12%. Okay. So plus face value you have already 10,000. Uh, Price is 10,600. Divide by n is 8 years to maturity. Divide by again 10,000 plus 10,600 divided by 2. Try to calculate and please tell me what is the approximate YTM you are getting.
Okay, sir. Sir, it's around 12,
Yes, correct.
12.008.
Yeah. So the secret is 12% was already given this. And if 10,006 is at 12%, so your market price, your YTM is equal to your coupon rate. Okay. So it was given up already. And a coupon rate of 12% paid annually, the market price is 10,600. So your market price is coming equal to at 12%. So this is your YTM. Okay. Perfect. Okay, so these questions please note it down. You can solve by yourself also. Face value. Anyway, I'll share the slide so you can go with the slide and try to solve it. No need to just write it down now. And Bhavna and Atul, today I will share the slides with you guys. You please share it with the class. Okay.
Okay, sir.
Mm. Now coming to the what is the term structure of interest rate? This we discussed. Like what is the term structure of interest rate and yield curve? The term structure of interest rate and yield curve actually explain the relationship between the interest rate and the maturity of the investment. Okay. You can read this analogy. I made it by myself. Imagine you are lending money to a friend. You might charge them a different interest rate depending on how long they need the loan. A short-term loan, a few weeks, might have a lower interest rate than a long-term loan, a year or more. This is similar to how interest rate works in the financial world. Okay, so generally we say for the bonds with having more maturity, the interest rate should be higher compared to the bonds having less maturity. Okay, because long-term risk is more, long-term uncertainty is more. Okay, so higher the maturity, higher would be the interest rate, and this should be at the normal course also. Like for the bonds with long-term maturity, the interest rate would be higher for that. It means the economy is doing pretty well. For short term, it is less. For long term, the rate is higher. So we call it nominal yield curve also. So basically, it tells the relationship between the interest rate and the time to maturity. Here, there are different types of yield curve. First is normal yield curve. In a normal yield curve, short-term interest rates are lower than long-term rates. This shape reflects a healthy economy with expectation of future growth and inflation. Investors typically demand higher yield for committing their funds to long-term investment. Why we are saying it is as indicator of healthy economy? Definitely, you have some kind of confidence in economy. That's why you are going to put your money for long term also. Doesn't matter you're asking high rate. Definitely you will ask high rate because future is uncertain. Is it down the 10, 15 years are down the line you have to invest, you put your money in, but at least you have confidence in the economy, that economy definitely our economy is doing well, long term is future prospect is high and it will keep shining like this. So this you will charge a higher interest rate, but you will put your money for the long term, you will have long term commitment also with your money. Okay, the second condition is inverted yield curve, which is just opposite of normal yield curve. What happens in this? Short-term interest rates are higher than long-term rates. Why? Because you don't have much confidence in the future of the economy. You think recession are going to hit the economy. You want to keep your money safe, or you don't want to even invest also. Okay, so this kind of okay, as we said, this kind of situation can expect economic slowdown, recession, or central bank are going to put more tight condition in the monetary market or monetary policies. Okay, then you have flat yield curve where you like what to say.
पंडित जी से पूछ लेना चाबी दी है तो मैं मोटर की पूछोगे पंडित जी उनने बॉबी ने दे दी चाबी पंडित जी से पूछ
यार जो भी है
दाद
प्लीज
पंडित
पुट
जी
योरसेल्फ ऑन म्यूट. Okay, then we have flat yield curve. So flat yield curve indicates the minimum difference between the short term, meaning like the difference between short term and long term is not much, and investors are indifferent. They don't know, like they think okay the condition is going to be same. It doesn't matter whether it is short term or in the near future. Then you have another yield curve which is called steep yield curve. So steep yield curve implies a significant difference between short term and long term. There's an extreme difference between both the rates. This shape can occur when investors anticipate either strong economic growth or high inflation expectation or potential future rates hikes by central banks. Generally, this we don't discuss much because this is a very rare phenomena. We kept ourselves restricted to three types of yield curve, which is normal yield curve, inverted yield curve, and flat yield curve. Okay, and this how we can explain them with the help of graph. So this is the data which I took just to show a numerical example only. So hypothetical data only from US market. Suppose you see the yield rate is 1.5%, 2%, 2.5, 3.5. So you can see for the longer maturity, the yield is increasing, the return is increasing, and that's how it will take the shape. The longer maturity bonds will have longer yield. Okay, so this is upward slope and calling as normal yield curve. Investors are expecting that growth potential is high and economy is doing well. The second was inverted yield curve. In this, you can see the as the maturity is increasing for 3.3 months, it is 2.5%, but for 30 years, it is just 1.5%. So short-term interest rates are higher than the long-term interest rate, and this is inverted yield curve. Okay. Then investors are expecting recession here, and they don't have much like they are very doubtful about the future growth and all, and they think okay recession may hit the economy, and it was the case indeed with US actually recently. That day we then I think Atul was there, we were discussing this. We went with the US website also and checked how this yield curve was being turned into. Okay, and then we have flat yield curve. So flat yield curve is like you will not find much differences. So there are differences to 2.2, then 2.3, then again 2.3, 2.4. So difference is not as much. Okay. So the short-term rates are equal to long-term rates, and there is no much difference, and investors are indifferent between the short-term and long-term investment. And this the same data we took in the Excel, and this how we try to interpret by ourselves also. So it is normal yield curve, upward slope, inverted yield curve, downward slope, and flat yield curve. So given this less number of data, this is not exactly flat, but the difference you can see is not much. 2.19, 2.2. Okay, then 2.2, 2.21. Okay, the difference is not much actually. So this is like kind of situation of flat yield curve, where the difference between the short term and the long term is not as big as it should be. Okay, or not very significant. Okay. So this was about yield curve, and guys, please, when we will discuss about duration. I think next time duration we'll discuss that time only. I'll tell one more thing. Okay, so now there are different theories of term structure of interest rate, which tries to explain the relationship between interest rate and their maturity of the asset. So the first theory is expectation theory. So expectation theory says the shape of yield curve actually reflect investors' expectation about what is going to happen to the interest rate in the future. So it says is about like normal yield curve kind of situation, that long-term interest rate are nothing. Like they say, even if you invest in the short term, it doesn't going to make much difference, because the long term interest rate are just an average of different short term interest rates. Okay, so just suppose if in this year's interest rate is 2%, next is 3%, the fourth year is 4%. So at the end of fourth year, they will just average it out and will try to say, okay, long term interest rate is just 2 plus 3 plus 4 divided by 3. Okay, this is called expectation theory, where they think that the short-term investors, the short-term interest rate, if you average them out, they will reflect your future interest rates as well. This is about expectation theory. Then we have liquidity preference theory. Liquidity preference theory says that liquidity is important for the investors, and that's why they prefer short-term maturity bonds over long-term maturity bonds, because long-term maturity bonds have less liquidity compared to short-term bonds. That's why in the very first slide where we were discussing that bills are more liquid because they are for short-term 3 months, 6 months, 8 months, 9 months only. Okay. So the in long-term rates will have higher rate of return compared to short-term because the liquidity is less and investors want to get compensated for the less liquidity. Okay, they say, okay, liquidity is less, but at least there should be enough compensation to put my money into into an asset which is providing less liquidity. Okay.
Regulator,
Yes.
sir, can you repeat the expectation theory, please?
Expectation theory says that the long-term interest rates are nothing but average of short-term interest rates. Okay. So you read it like this. The expectation theory suggests that the shape of the yield curve, the graphical representation of the term structure, reflect investors' expectation about future interest rate. It posits that long-term interest rates are an average of current short-term interest rate expected over the same period. You can take the example, like as I said, the first investor is expecting the short-term interest rate to be 2% in the first year, 3% in the second year, and 4% in the third year. The second investors are expecting the rate 3% first year, second in 4% in second year, and 5% in third year. Similarly, there is an investor third who is expecting 4% in short term, first year 5%, and then 6% in second year, sorry, third year. So according to expectation theory, if you go and ask investor one, what should be according to you the interest rate at the end of third year? He'll say, I don't care what should be the third year interest rate, but what I can tell, I have three expectation. This year interest rate is 2%, next year it is 3%, and the next to next year it would be 4%. So according to me, 4 plus 3 plus 2, 9 divided by 3, 3% should be your third year interest rate. It is just nothing but just average of last 3 years, my expected 3 years interest rates. Okay. So in generally, what do we say? We don't find this kind of direct relation. Okay, after 10 years, the interest rate would be just average of 9 years or 10 years. No, it could be different. But according to expectation theory, the long-term interest rate is just nothing but the average of short-term interest rates. Okay.
Okay, sir. Okay. Thank you.
Then we have liquidity preference theory we have discussed. Then market segmentation theory. Market segmentation theory says there is no such thing called short term, long term. It depends what kind of market the investors are interested in. Either there are two types of investors: those who are liking to invest for the long term bonds. In long term bonds, they will go for that kind of particular market segment. Those who are interested in the short term bond, they will go for this kind of particular market segment. Okay, so they will just have their different preferences and they will have their different market segmentation, and based on which they will trade. There's nothing like short term, long term at all. This is about your interest or your preference, which market condition or which kind of bond you want to make your interest in, your invest in. Okay, so these are some theories around yield curve. So just read them again for your exam also. Now coming to the another concept called duration, which is very one of the highly important concept, which measures actually bond sensitivity to change in interest rate. Then last time also we were discussing, but you get confused sometime. We are calling it duration, but we are measuring the interest rate sensitivity. So the purpose of duration was to calculate the effective maturity or the average maturity at the end of which the investor will get his return. So, see, this is like that. You invested 1,000 rupees today for 5 years and you are getting 50 rupees per year as a coupon. But can, very common sensically, you can assume, you can think you are just not going to get your 1,000 rupees at the end of 5 years. There is some portion of your 1,000 rupees investment in the form of coupon you have already got in next 5 to 4 years. So that your effective maturity is exactly not 5 years. Your maturity is less than 5 years because some portion of your investment you have already recovered in the form of coupon payment. And that's how this duration is called, which is effective or average maturity at the end of which you are actually will recover your investment. But the purpose is solved two purpose. One is solved that it help you to calculate in the average maturity. It also solved that what it found that somehow it is telling what will be the interest rate sensitivity of that bond price. It also helps you in understanding how bond is sensitive to change in interest rate, because the methodology and all the way it was calculated, it also helps in understanding the interest rate risk of that particular investment. So there are some like you can just think in a simple way. The firstly, there is an inverse relationship between bond price and interest rate, which we have already discussed. Second, duration helps in estimating how much a bond price will change in response to change in interest rate. A longer duration means that the bond price will be more sensitive to interest rate changes. Thirdly, duration is expressed in years and it represents the approximate percentage in the bond price for every 1% change in interest rate. So for example, if a bond has a duration of 5 years and interest rate increased by 1%, the bond price would be expected to decrease by approximately 5%. That's the property of duration. It assumes linear relationship between interest rate and bond price. Conversely, if interest rate decreased by 1%, the bond price would be expected to increase by approximately 5%. Okay, as I said, the longer of the duration of the bond, a more sensitive it would be to the interest rate change. Okay, this is because longer maturity have a greater number of future cash flows, interest payment and principal repayment that are impacted by change in interest rate. Okay, because you have large number of future cash flows, the longer it would be, the higher they will be affected by the interest rate changes. And another theory is also long term is more uncertain compared to short term. Okay. Now the question is, which I was discussing the last time, why it is called duration and why it is expressed in years. So the answer lies in the third point. The number of years in duration doesn't directly represent the percentage change in price for a given interest rate change. Instead, it acts as a scaling factor or multiplier. Okay, now you read the first point. Duration is named as such because it measures the weighted average time to maturity of a bond's cash flow. The value it tells in, it comes in the form of number of time to maturity. It essentially calculates the time it takes for an investor to be repaid the bond's price by its total cash flows, interest payments, and principal repayment. The reason duration is expressed in years is that it represents the effective maturity or the average life of the bond's cash flows. It is a time measure similar to how a bond's maturity is expressed in years. But with this number, you can just scale it up, and you can also calculate the price sensitivity of a bond to the interest rate change. Okay, so for suppose how it works, like a bond with a duration of 5 years means that its cash flows have an average life of 5 years. If interest rate increase by 1%, the bond price will decrease by approximately 5% because it is multiplying this factor. So that's the magic of the calculation. They got it out. Okay, then interest rate decrease by 1%, it may increase approximately 5%. So the duration number itself doesn't tell you the exact price change, but it provides a way to estimate the percentage change in price for a given interest rate change. So that's why you should not get confused with duration. I was confused for almost 2 years. So somehow I just got some answer from my professor. So this is a term they use it, but along with the duration, that duration you have calculated, because you have to calculate the duration, you took into account the coupon payment, you took into account their present value. You also came out with because, and to calculate that coupon ka present value, you need a YTM or you need a required rate of return. So you have adjusted for that also. That's why duration, once you have calculated duration, you have considered so many factors which will be discussed in numerical example also. That duration itself is telling you the price sensitivity as well. Okay, so generally nobody actually put much focus on this clarification, but sometimes in the subconsciously we are always confused why they are calling it duration error. That's why I try to cover it. So maybe you can read about it more and just, but the main purpose of duration is to calculate the sensitivity of a bond price to the change in interest rate. Okay, then what is the difference in maturity and duration? So maturity refers to the specific date when the principal amount of a bond is scheduled to be repaid in full. If the remaining time to time until the it is the remaining time until the bond's expiration date. Okay, maturity is fixed. For example, 10 years maturity means 10. But the duration, as I said, is the price sensitivity to change in interest rate. Duration takes into account not only the maturity date, but also the timing and size of each cash flow. It is expressed in years, but it is not as same as the maturity date because it is taking into account your coupon payments also, and try to calculate the effective or average maturity at the end of which your payment will be repaid. This is just leave this. This is a story. I just tried to solve in that class. Okay. Now just consider an example. Whoever was interested in this duration calculation, please pay attention more. So consider bond with the following characteristics. There's a face value 1,000, annual coupon payment 50, years to maturity 5 years, yield to maturity a year. Sorry. Okay, this is maturity years actually 5 years, and your YTM is 4%. Okay. Or I can quote it just maturity. Okay, then so we will calculate duration with this following steps. Okay, the first step is first to calculate the present value of each cash flows. Okay, so same way as I said, the bond valuation is very fundamental actually. You will keep using that thing again and again, and it will help you in calculating so many concepts in future also. Okay, so you will calculate the present value of each cash flows. The present value is like 50 coupon you are going to receive at the rate of YTM is 4%. So same way present value coupon divided by 1 plus YTM, or you can use the direct formula also, and that's how you will calculate the present value of coupons. The second step is you will calculate the weighted average time to receive each cash flows. For that, the formula is present value multiplied by the time divided by the market price. Okay, or you can solve it in the step 3 also, where you will calculate the present value of coupon 1 and multiplied by 1, present value of coupon 2 multiplied by its time yani ki year 2, but present value of coupon 3 multiplied with year 3, present value of coupon 4 multiplied by 4. So that's how you will calculate the weighted average time to receive each cash flow. What is weighted average time here? Weighted average time is here nothing, but you will multiply your present value with the time, and that's how it will become your weighted average time to receive your each cash flow. You just take the example.
Excuse me, sir.
So, yes,
Sir, can you show the previous slide?
this one.
Yes.
I will share the slide also. Don't worry. Today only I will share the slide.
Okay, sir. You can proceed.
Okay. So suppose we had this example, the present value for 1 year was, so this that's how we will calculate the present value, no? So this was 50, 50, 50, 50, right? So it is the present value here. It is given here. The for first year it is 48, for second year 46, then 44, then 43, and then present value plus your maturity value in total is 864. That's how you have calculated the duration. And divide by the market price, your duration should be how much? If anyone wants to calculate, or shall I show in the next slide? Okay, let's show in the next slide. There's another way to calculate duration. This I find more easy, and it will help you to calculate more, like you will not forget this thing very easily. It is much better way. So take the time, the first column, then second dedicated to the cash flows, third to the present value factor, fourth to the present value, and fifth present value multiplied by time. Once you have done it for all the 5 years, at the end of which you will sum two things: present value, which is 1046, and present value multiplied by time, the sum is 4767. Just divide this 4767 with 1046, you will have your duration. So you can see this present value into time, summation of present value from time from 1 year to n. This is present value multiplied by time. Present value multiplied by time. Present value multiplied by time. Okay, it is here. It is summation, so you have already done summation, so you don't need to do one by one. You just take this value 4767 divided by the price. Price is 1046. Now tell me what should be the duration. It should be 4 point something, right? Okay, whatever, just calculate it, nothing. There's another way also to calculate now, more easier way. Suppose you don't want to do this also, you can do this also. Now the first column is time, second is your cash flow, third is your present value factor, fourth is your present value. Fifth, you can give weight. What is the weight? Weight is your present value of that particular year to is compared to overall present value. Okay, so total is 1046. 48 divided by 1046, the weight is 0.45. The weight of the first present value is 0.45. The weight for the second is, I think it is something else. Don't know how. Correct only. So 48 divided by 1046.45, 46 divided by 1046, it would be 44. So that's how you have calculated the weight. Okay. Then you multiplied weight with directly time, and at the end of sum it, make a sum. And this this 4.13 add 0.164, then 0.129, 0.088, 0.045. You add all this, you will have your duration. Okay, so that's how you can calculate duration, like in 3 ways. Got it? Shall I repeat, or is it okay? Harshit, whoever was asking, shall I go ahead, or like you want me to repeat it? Hello. Okay. Let's move on. This we have now, we discussed about Macaulay duration or normal duration, but now we have modified duration. What modified duration do? Modified duration adjust this normal duration according to the YTM also. Okay, so modified duration is nothing but the standard duration divided by 1 plus YTM power by n. So generally modified duration adjusts the normal duration to the according to the YTM, and thus it is much better measure than plain duration or Macaulay duration or simple duration. That is modified duration. Now the third concept we have is convexity. Okay, so whatever duration you have calculated, if you divide it by 1 plus YTM, you will have modified duration. Okay, now we have convexity. So what was happening here? Duration was actually assuming that the relationship is linear. But convexity says the relationship cannot be linear. The property of convexity tells. By the way, here I want to tell you, there are certain assumptions or property of duration, or we call it Malkiel properties of duration. Please read those. They could be useful for your exam. Okay. So try to read them from your book or Google. Okay. Then we have convexity. Convexity actually tells the relationship may not be
सर
linear
क्या
and it
क्या बोला है?
Malkiel
सर क्या रीड करने?
हाँ, malchiel properties of duration पढ़ लेना भाई, MALKIEL, MALKIEL.
Okay, sir.
Hmm.
Sir, can you just show me the formula of modified duration?
Modified duration. This is more sophisticated formula, but you do one thing. You just divide standard duration divided by 1 plus YTM. Okay.
Okay, sir, standard duration कैसे, वो जो लास्ट फॉर्मूला है?
हाँ, ये तुम्हारा स्टैंडर्ड ड्यूरेशन था ये,
ठीक है, ठीक
और इसको 1 प्लस YTM से डिवाइड कर दो, तुम्हारा मॉडिफाइड ड्यूरेशन आ जाएगा. ओके.
है. Okay.
ठीक. Then you have your convexity. So convexity tells the relationship is not linear. It could be curvilinear. So what is the concept of convexity? The concept of convexity in the context of bond refers to the relationship between a bond price and its yield to maturity. Same thing. A bond is considered convex if its price sensitivity to change in interest rate is not constant or linear, but rather changes in a non-linear way. Okay, so we were saying 1% and 5 years duration means that 1% increase may lead to 5% decrease, or 1% decrease may lead to 5% increase. But convexity says this relationship is not as linear as duration is telling. It could be curvilinear. What happened in that case? If price tend to in that case, price tend to rise more for a given decrease in interest rate, then it falls for an equivalent increase in interest rate. Meaning, when the interest rate is decreasing, price will increase, and this increment will actually be higher if the price will go down in the case of interest increase. Okay, listen again. If interest is going down, price will increase. If interest is going up, price will decrease. But this decrease will be less compared to that increase, or we can say that increment will be higher than compared to decrease with the same percentage of change in interest rate. Okay. So it is sometimes good for investors because they provide them degree of protection against interest rate risk. So example is also given here. So suppose you have a 10 years bond with a coupon rate of 5% and a par value of 1000. Assuming the YTM is 5%, the bond price would be 1000 at par. Now let's consider two more scenarios. Interest rate decrease by 1%, causing the YTM to drop to 4%. As a result, the bond price would increase, say, to 1090. Similarly, if interest rate increase by 1%, bond price will go to 920. So you can check the difference. The difference between 1000 and 920 is 80, but the difference between 1000 and 1090 is 90. That's what it was saying. The price will increase more compared to decrease for the same level of change in interest rate. Okay, that is called convexity property. And how do you calculate convexity? This is the formula to calculate the, or step to calculate the convexity. So in the first step, you will calculate again the present value. See, go to the base. Again, you will calculate the present value. In the second step, here you will do slight difference. I will show you the table also. How do you do? If you do convexity and duration both in the table, like with the help of table, no, that it would help you, and you will keep remember it. So again, you will wait by time and square the time. You have some, then you will again add all these things divided by price and YTM. You will have convexity. This is the convexity formula. You can write it down also. 1 divided by P price multiplied by 1 plus YTM power 2. And then you have this summation of cash flow divided by 1 plus Y power T square plus T. Now you try to solve it with the help of example. You will understand it better. So suppose the face value is 1000, coupon is 10%, YTM is 12%, market price is 952. What is the convexity? So the first column would be your cash flow, 1, 2, 3. Time is, sorry, it's just ulta. Time cash flow is 100, 100 and 1100. Okay. Wait, let me correct it, otherwise you guys will. Okay, then you have present value factor, you have present value. Here one more thing you will add it, you will time square plus t to address the convexity issue, t square plus t, and then you will have present value multiplied by t square plus t. You will sum all these things and you will put this into this formula and you will have the value. But surprisingly, why I was telling you, oh, good thing is why I was telling you to solve it with the help of table. You don't need to do many things. So suppose you add all these things, this entire portion is nothing, just summation of these things. So you don't need to mug up the formula. You just sum all these things and this the entire portion will be covered. And this is nothing 1 divided by price. What is the price? 952 multiplied by 1 plus y time. This is 12% square. That's it. And that's how you will calculate your convexity. Okay, and this will also help you what would be the percentage change in the price as a given percentage change in interest rate. Okay, this you leave, you can read by yourself also how to calculate this yield curve, zero yield curve, coupon yield curve and all. Now let's talk about unit 3. 7:37. Just give me 5 minutes break. I'll have some water and then I will start. Okay. I'll come in 2 minutes only. Let me just get some water. Okay, so since we have covered 2 units here, so what will I do? I will share this all the study material right now. Bhavna is here, Atul is also here. I will share it with both of you. I know you guys already have it, but I want like Bhavna, if you can share it again with these people. And I'm sharing right now since 2 units are covered and whatever we have covered in unit 1 and unit 2, I'm sharing all these things. And right now it's 7:38, so it's 2.5 hour class is always already covered. So now I'm giving you just 1 hour. It's not a break. You read all that material right now. That is also part of this class. And then 8:30 we have already covered. I think let me see. Um, 38. So quickly we will cover remaining slides and 8:30 we'll start this class again. Okay. So Bhavna, I'm sharing it with you and Atul with you also. You can keep it for for you also and just share it with the class. Uh, let them read. Okay. Okay.
Sir, can you send the material in the chat box also?
No, I cannot do like that's the only thing. No, I cannot chat or I cannot do anything here in the chat box. That's why I was sharing it with Bhavna and Atul also. So I don't
Okay,
have
sir.
right.
Sir, can you share with me on WhatsApp?
Harshit, I'm not like sharing on WhatsApp. I generally share it with mail. See, you have my mail ID. I've already shared my mail ID. Do one thing. If you don't get, you just let me know. Let's just them share first, and then if you don't get, you just let me know. I will share it with you in person. Okay?
Okay, sir.
Yeah, they will share immediately. Don't worry. They'll just share in 5-10 minutes. I'm sharing it with Bhavna and Atul. And Bhavna, just you share it with everyone. Atul, you keep it with you only. Okay, so they have been like regular in the last all 9 to 10 classes. So I'm sharing with them only and they are doing it well. Okay, so I'll share it with them and then let them share with you. So right now I'm stopping sharing my screen and you guys go for like up to 8:30. After 8:30 we will solve this class, but please do not just take it a break. You can eat also if you want in between, but try to read those things. They will help you because after what I'm trying to do here, you can actually cover most of the portion if you can read all this material also, and you don't need to like give extra hours for your exam. Okay, so I'm stopping my sharing my screen here and then you can just do it. Okay, Bhavna, shall I share? Oh, I think she is also not here. Atul, I think both of them are not here. Hello, Bhavna, Atul. Harshit, can you hear me? Like, am I
Yes, sir. Yes,
audible?
yes, sir.
Both of them are not here. Then
Yes.
you have mail ID for everyone.
Sir, I
Like,
can
can you?
share with in the official group
Okay, okay. Then do one thing. I'm
WhatsApp.
just okay. I'll just give me 1 second. I'll ask your mail ID. Tell me your mail ID.
Harshit B
HARSHIT हर्षित B
294
294
@gmail.com।
@gmail.com।
जी
करेक्ट।
सर, फर्स्ट लेटर H स्मॉल रहेगा,
हाँ हाँ, वो मेल आईडी का
विदाउट गैप।
बाय डिफॉल्ट होता है, मेल आईडी में स्मॉल ही होता है। सो हर्षित
ओके,
HARSHITB 294 @gmail.com, करेक्ट।
यस सर,
You don't have any photo on mail ID, right?
यस।
Hmm. I'm sharing with you right now. You please share it with the class.
राइट सर।
It covers the unit 1 and some portion of unit 2.
सर टोटल कितना यूनिट है?
Total 5 है, but I'm covering 4 only because one unit has already been covered by Manisha madam. Okay.
सर नाम क्या है उसका यूनिट?
यूनिट देखता हूँ, आएगी, मैं नाम बोल गया, बताता हूँ, आएगी तो
ओके,
बता दूंगा बीच में। ठीक है। सो मैंने शेयर कर दिया। फिर इसके बाद 8:30 या 8:40 पे हम क्लास स्टार्ट करेंगे।
सर
देन
एक क्वेश्चन।
हाँ हाँ, बताओ भैया।
सर ये कन्वेक्सिटी जो है हम लोगों की,
हम्म।
उसमें हम लोगों ने जो फॉर्मूला था उसमें T² + T लिया था हम लोगों ने।
हाँ, वो क्यों लिया
फॉर्मूला
था?
है सर? हाँ जी सर, वो मतलब T² + T क्यों किया जा रहा है सेम टाइम का?
एक्चुअली हम लोग कवर इसको एडजस्ट करते हैं कन्वेक्सिटी के लिए, एडजस्ट करते हैं इसको। मैंने कन्वेक्सिटी में बोला ना कि रिलेशनशिप लिनियर नहीं है, तो लिनियर बायसनेस को हटाने के लिए हम उसको T+2, तो स्क्वायर जब भी हम किसी चीज का करते हैं तो जनरली वी ट्राई टू रिकवर इट फ्रॉम लाइक लिनियर बायस। एक और चीज ये है कि इसके पीछे इसका एक मतलब मैथमेटिकल कैलकुलेशन भी होती है, दैट इज स्लाइटली बिग, आई कैन कवर दैट आल्सो, बट राइट नाउ यू कैन जस्ट कीप दिस इन योर like for your exam purpose or for your own calculation purpose, that we try to remove the linear biasness and that we try to make it non-linear. Okay.
सर ये नॉन लीनियर बनाना है उसको
हाँ जी,
या लीनियर बना?
नॉन लीनियर, लीनियर रिलेशनशिप नहीं हो सकता, कन्वेक्सिटी बोलती है कि लीनियर रिलेशनशिप नहीं है।
अच्छा,
ठीक है।
ठीक है सर, ठीक।
तो मैंने शेयर कर दिया हर्षित तुम्हारे साथ,
यस
प्लीज
सर।
शेयर इट
सर 6
विथ।
PDF है।
आ गया ना?
हाँ, 6 PDF है सर।
हाँ हाँ, सबके साथ शेयर कर दो। क्लास विल स्टार्ट एट अराउंड 8:40, तो उसके बाद विद इन
सर ये
1 hour आई
वन
ट्राई।
एक यूनिट को छोड़ के पूरा पूरा सिलेबस है ये?
नहीं नहीं, ये यूनिट 1 और यूनिट 2 है। फिर यूनिट 3 यूनिट 4 में ज्यादा शेयरिंग मटेरियल नहीं है, एक या दो ही चीजें हैं, वे मैं शेयर बाद में कर दूंगा क्लास खत्म होने के। ठीक
ओके,
है।
ओके।
तो अब नेक्स्ट 1 hour और लाइक 45 to 1 hour वी विल बी ऑन दिस लाइक रीडिंग ब्रेक, यू रीड इट एंड देन उसके बाद जो 1 घंटा बचेगा वी विल ट्राई टू कवर द सिलेबस। ओके। और इफ यू आर नॉट
सर बाय लॉन्ग ना सर?
हाँ,
सर एनी
सर बाय
एग्जाम
लैंग्वेज
आइडिया
एक्सप्लेन
रिलेटेड
करके तो
क्वेश्चन?
बेटर अंडरस्टैंडिंग होती है हमें, और मुझे ही नहीं सबको ये सही रहता।
क्या क्या करूं फिर बताओ,
बाई
मुझे मैं
लैंग्वेज
समझ।
एक्सप्लेन, हिंदी इंग्लिश दोनों में एक्सप्लेन कर देते सर, तो जो कंटेंट है।
अच्छा, ठीक है, बट पता नहीं, मैं कर सकता हूँ, मुझे कोई इश्यू नहीं है, बट आई डोंट नो,
हाँ
लाइक आई थॉट इट्स लाइक काइंड ऑफ स्टैंडर्ड थिंग्स।
नहीं
ओके,
नहीं,
आई ट्राई।
ठीक है सर।
ठीक है, बट मेरे को लगा यहाँ पे कोई ऐसा ना हो, लाइक मे बी सम मे बी पर्सन फ्रॉम द साउदर्न स्टेट और सम अदर स्टेट, दे डोंट अंडरस्टैंड हिंदी, सो इफ एनीवन
सर
इज हियर प्लीज
बाय
लेट मी नो। और मतलब तुम्हारी क्लास में भी कोई ऐसा हो सकता है ना हर्षिता, इवन आई डोंट हैव एनी प्रॉब्लम इन एक्सप्लेनिंग हिंदी, बट हो सकता है जो रिकॉर्डिंग सुन रहा है वो शायद साउदर्न स्टेट से हो या किसी और स्टेट से हो जिसको ना हिंदी आती हो, तो दैट कुड बी। सो आई ट्राई माय बेस्ट, व्हाट विल आई डू, आई ट्राई टू कवर सम जो जो थोड़ा डिफिकल्ट है उसको थोड़ा हिंदी में कवर करने की कोशिश करूंगा और इंग्लिश में भी, दोनों को साथ साथ कवर करने की कोशिश करूंगा। इज इट ओके?
लेक्चर सर हिंदी इंग्लिश दोनों में ही होते हैं, बाइलिंगुअल होता है जितने
हाँ हाँ,
लेक्चर्स
ठीक।
होते हैं।
अच्छा, तुम्हारे सब लेक्चर हिंदी इंग्लिश दोनों में होते हैं?
हाँ सर,
तो मैं
चाहे वो
फालतू।
कंटेंट चाहे रिस्क
That's the
मैनेजमेंट का हो।
mostly.
और तो मैं ज्यादा अंग्रेजी बोल गया, तो तुम लोग मुझे पहले बता देते यार, मेरे को कौन सा बोलने में इतना वो लग रहा है, मैं पहले कवर कर लेता, सॉरी। बट नोबडी टोल्ड मी ऑल्सो, तो अगर तुम लोग पहले बता देते तो आई कुड हैव कवर्ड अर्लियर स्लाइड्स ऑल्सो इन हिंदी और इंग्लिश दोनों में, थोड़ा कवर हो जाता।
ठीक है सर, ठीक है, अब से सर कवर कर दीजिए, ठीक है।
ठीक है, चलो तो तुम लोग जाओ फिर
Sir,
8:30 तक। हाँ बताओ भावना।
sir, have you shared study material? मतलब
तुमने मिस
PPT?
कर दी, तुमने मिस किया तुम
Sir,
क्लास में।
I was outside.
हाँ तो मैंने 3 बार बोला, फिर मेरे को बाद में हर्षित के मैं ये बोला तुम्हारे पास ऑलरेडी ये सारी स्लाइड्स और पीपीटीज है वो है, तो वैसे मैंने एक बार और शेयर कर दिया, मैं इसके बाद अतुल को और तुम्हें दोबारा शेयर कर दूंगा, और पीपीटी भी तुम सबके साथ शेयर कर देना। आई थिंक इन
Okay.
लोगों में से कुछ को दे आर नॉट एबल टू गेट द पीपीटी, सो प्लीज आफ्टर यू शेयर जस्ट ड्रॉप ए मैसेज इन द ग्रुप कि प्लीज लेट मी नो इफ एनीवन लाइक
I've
किसी को
shared
नहीं
it
मिला।
in finance group.
ओके नहीं, बस एक बार पूछ लिया करना भावना कि अगर किसी को नहीं मिला तो प्लीज मुझसे पूछ लो, भावना दोबारा शेयर कर देगी, ठीक है। तो जस्ट
Okay.
आस्क लाइक दैट। ठीक है, तो अभी मैंने शेयर कर दिया है, दैट यू ऑलरेडी हैव, सो यू डोंट नीड टू हैव दैट अगेन, नाउ हर्षित हैज शेयर्ड इट ऑलरेडी। आई विल शेयर दिस पीपीटी,
I
विल
have
करेक्ट
only
इट।
one PPT.
इट्स ओके, मैं फॉरवर्ड कर दूंगा मेल बाद में। अभी तुम लोग, अभी कर रहा हूँ, तो तुम लोग 8:30 और 8:40 तक इसको पढ़ो, ठीक है। तो
Okay.
सेंट में ऑलरेडी हर्षित को मैंने शेयर किया था।
सर एग्जाम रिलेटेड थोड़ा पैटर्न भी आप बता देंगे तो थोड़ा हेल्पफुल होगा।
बताऊंगा, बताता हूँ, आज बताता हूँ क्लास के एंड में।
ओके सर, थैंक
भावना,
यू।
अतुल,
सर मैंने व्हाट्सएप ग्रुप में शेयर कर दिया है
ठीक है भाई, ठीक है, मैं भी कर
सबको।
दिया। ये लोग, इनका थोड़ा सा वो है कि ये लोग मेरी क्लास में कांस्टेंट रहे हैं आप शुरू से ही, तो मेरे को सुनना पड़ता है उनका। तो ठीक है, मैंने शेयर कर दिया उनके साथ, दोनों के साथ भी। और तुम लोग प्लीज इसको पढ़ो 8:40 तक, 8:40 हम क्लास दोबारा करेंगे। बाय 9:30 हम लोग इसको खत्म करेंगे, और 10 o'clock तक हम खत्म करेंगे, फिर मैं पीपीटी शेयर करूंगा, यू गाइज कैन कंटिन्यू विद योर स्टडी, ठीक है। ओके चलो गाइज, ठीक है
ओके।
हर्षित जी।
थैंक यू सर, थैंक यू।
Hello everyone. Oh, not everyone. I think only 4 left. Uh, Hello, am I
Yes,
audible,
sir.
Bhavna?
Yes, sir.
You can either, I think you can drop a message in the group if they want. They can come back. Like I'm going to start this
Oh,
class again.
okay, I will.
Thank you.
Done, sir.
Okay. Thank you, Bhavna. तो अभी हम यूनिट 3 we will try to cover. Let's see कितना हो पाता है आज. स्क्रीन विजिबल है, भावना?
हाँ जी, सर.
ओके. मैं स्टार्ट कर देता हूँ. लेट देम कम. ठीक है, क्योंकि टाइम जस्ट 1.5 hour वी हैव टू ट्राई. लाइक तीसरा और फोर्थ यूनिट बोथ वी हैव टू कवर. ओके, और जस्ट वेट 1 minute मे बी सम कौन ज्वाइन करता है. तो बाकी आप कोई सब्जेक्ट कौन सा कवर कर रहे हैं आपके 4th सेमेस्टर में? भावना, लाइक कैन यू टेल मी लाइक 1 or 2 सब्जेक्ट्स नेम फाइनेंस में.
सर ऑलमोस्ट सबका हो गया है एक्सेप्ट फॉर मर्चेंट बैंकिंग.
और कौन सा सब्जेक्ट है 4th सेमेस्टर में फाइनेंस में?
फाइनेंशियल रिपोर्टिंग, फाइनेंशियल रिस्क मैनेजमेंट, फिक्स्ड इनकम
एफआरएम कौन ले रहा है?
सिक्योरिटी, क्वांटिटेटिव. हाँ,
ये एफआरएम कौन ले रहा है, फाइनेंशियल रिस्क मैनेजमेंट?
शुभम सर.
अच्छा, चलो, फ्रॉम दिल्ली यूनिवर्सिटी.
आई डोंट रिमेम्बर दैट.
ओके, नो इशू. ठीक है, फिर मैं स्टार्ट करता हूँ. देन विल कवर इट क्विकली. दोज हु आर नॉट हियर कैन गो विद द रिकॉर्डिंग. चलो इसको
Yeah,
स्टार्ट करते हैं. यूनिट 3. आई थिंक
sure.
इफ पॉसिबल विल ट्राई एज मच एज पॉसिबल. अगर कोई थ्योरी पोर्शन है देन वी कैन लीव. दे कैन गो विद द स्लाइड्स, राइट?
Okay.
Slides I'll try my best to share today itself.
Okay.
Hmm. नहीं चल रहा है. Okay. So unit 3 was about volatility. So we discussed key volatility. What is volatility? Is nothing but the fluctuation or ups and down in the like high or low in the price. So when stock market is facing kind of turbulence, or we say okay the price is showing too much uncertainty or fluctuation ups and down, तो उसको we try to tell that the market is more volatile. तो बेस उस पे देर आर लाइक टू टाइप्स ऑफ वॉलेटिलिटी. एक होती है हाई वॉलेटिलिटी, दूसरी है लो वॉलेटिलिटी. व्हाट इज हाई वॉलेटिलिटी? High volatility in the sense that the fluctuation is actually too much, or the fluctuation is bit high, but it can be in either direction. It can be positive, it can be negative. but it is not like volatility is a condition of high profit or low profit. Volatility in the sense ki it is telling that how uncertainty or how uncertain the market is going to be. Okay, so this is the concept of volatility. We can read this definition also. In a world of finance goes beyond just how high or low a price goes. It's a measure of how much and how quickly the price of investment fluctuates over a specific period. In simpler terms, it tells you how wild the price ride is for a stock, bond, or any other asset. So it could be for stock market, it could be for bond, it could be for interest rate, it could be for your purchasing power, it could be for anything. So volatility means how high and low it can go. In bond, it can go in दोनों direction में. नीचे भी जा सकता है, it can go ऊपर also. And maybe recently आप लोगों ने देखा होगा that is अभी जो इंडियन मार्केट में भी चल रहा था या अभी यूएस मार्केट में भी जा रहा था या यूके मार्केट में भी जा रहा था जहाँ पे there was too much fluctuation ups and down in the stock market and it happens mostly around some uncertainty और कुछ ऐसे events जो may affect the situation very badly, like for example वॉर के टाइम पे ये हुआ था, अभी इजराइल क्राइसिस हुआ था, दैट डे आल्सो स्टॉक मार्केट shows lot of volatility, and also that is the basic concept is like how high and low the price can go, how high and low index can go. Based on that fluctuation we identify it as how volatile or volatility is there in the market. ठीक है, then coming to the bond price volatility. Bond price volatility is actually is about the fluctuation in the bond market price given the change in interest rate. The interest rate could be like either high or low. We discussed in the very first or 2-3 slides कि जब interest rate बढ़ रहा होता है then price is going down, और जब interest rate घट रहा होता है then price is going up. So in that situation, if there's too much fluctuation in the interest rate, in the sense of the like it happened in the US market also, it is happening in Indian context also, that if interest rate is increasing or decreasing too quickly and too rapidly, so we can say that bond market is becoming more volatile given the change in interest rate. So we this relationship we already know कि जब interest rate ऊपर जाता है that price goes down, और जब interest rate नीचे जाता है that price goes up. Okay, so ये एक आर्टिकल हमने डिस्कस किया था तब that that day business standard का it was an article कि Indian market has less volatility. Okay, but at the same time I showed the graph of US also कि US में volatility थोड़ा बढ़ रहा है over the time, and how why it is like it kind of some पैराडॉक्सिकल थिंग एंड ऑल, बट इतना कंट्रास्ट था उसमें. उसका रीजन ये था कि दैट इंटरेस्ट इज काइंडली फेसिंग दिस काइंड ऑफ सिचुएशन गिवन देयर इंडल्जेंस विद ऑल दिस थिंग, मिडिल ईस्ट थिंग एंड ऑल. और अभी इन्फ्लेशन उनका थोड़ा सर्ज हुआ था, तो दे वर ट्राइंग टू कंट्रोल दैट आल्सो. बट इंडियन केस दे वर थिंकिंग ओके देयर माइट बी सम स्टेबिलिटी इन कमिंग ईयर्स एंड we are going to get a strong government whoever it is, and then market will be stable. ठीक है, तो ये एक कंडीशन थी कि why Indian market was bit calm compared to in the last 5 years, the volatility was the lowest. Okay. अब कॉन्सेप्ट आता है हाउ डू यू मेजर द वॉलेटिलिटी. सो दैट डे वी डिस्कस्ड कि दो मेजर्स आर मोस्ट इंपॉर्टेंट. वन इज स्टैंडर्ड डेविएशन एंड वेरिएंस. Variance and standard deviation are the same, or standard deviation actually standardized form of variance. So this is a very common and popular method to measure the volatility. That day we discussed it in Excel sheet also, that how to measure this volatility with the help of standard deviation. We discussed step by step. हम लोगों ने देखा था कि कैसे पहले आपको प्राइस यू हैव टू कैलकुलेट, उसके बाद उसका रिटर्न, फिर उसका डेविएशन, उसका मीन कैलकुलेट करने के बाद देन यू हैव टू कैलकुलेट स्टैंडर्ड डेविएशन. स्टैंडर्ड डेविएशन ही तुम्हारा फिर वॉलेटिलिटी होगा. इसी स्टैंडर्ड डेविएशन के बेस पे वी एक्चुअली कैलकुलेटेड if you remember value at risk also. So that also we will discuss. That Excel sheet I will try to share it again today. Now the thing is, what are those factors which affect volatility? So there are multiple factors actually. So the first is market condition, कि what is going on in the economy, कि economy कितना uncertainty, interest rate कैसे change हो रहा है, या फिर कोई अगर major event आ रहा है market में, like अभी same things are going on अभी, या फिर कल कुछ ऐसे सिचुएशन आता है where you that like kind of war kind of situation, or like any some fight happens, or some like pandemic के time पे हुआ था, then so that kind of situation may affect the overall economic environment, and market also behaved accordingly. It is would be bond market or stock market, दोनों का रिएक्शन डिपेंड करता है, और ये डिपेंड करता है कि उस मार्केट में पर्टिकुलरली इंटरेस्ट कितना है। तो जैसे उस दिन मैं बोल रहा था, इसराइल के वॉर से टाइटन के शेयर पे क्यों इम्पैक्ट पड़ रहा है? इसलिए इम्पैक्ट पड़ रहा है क्योंकि टाइटन का शुड बी सिग्निफिकेंट स्टेक इन Israel or somewhere. So suppose you are making a port in Iran, और अडानी या कोई भी वहां पे एक पोर्ट बना रहा है ईरान में, और सडनली वॉर काइंड ऑफ सिचुएशन स्टार्ट, सो व्हाट विल हैपन? तुम्हारा प्रोडक्ट स्टॉप हो जाएगा, तुम्हारा सप्लाई चेन डिस्टर्ब हो जाएगा, तुम्हारा रिवेन्यू डेफिनेटली गिर जाएगा, प्रॉफिट कम होगा तो शेयर होल्डर्स के लिए प्रॉफिट कम होगा। अगर शेयर होल्डर्स के लिए प्रॉफिट कम होगा, व्हाई डू यू वांट टू इन्वेस्ट इन दैट काइंड ऑफ कंपनी? डेफिनेटली शेयर प्राइस विल गो डाउन। So these kind of situation may affect your overall economic environment, and based on that overall economic environment, your share price or your market price or your bond price may also show some kind of fluctuation or volatility. Then कुछ factors है जो बस कंपनी स्पेसिफिक होते हैं। फॉर एग्जांपल, उस कंपनी की फाइनेंशियल हेल्थ क्या है, कंपनी कितना अच्छा कर रही है, उसके रेशियोज क्या हैं, उसका फाइनेंशियल स्टेटमेंट कैसा रहा है, कंपनी का टोटल ओवरऑल प्रॉफिटेबिलिटी कैसी रही है। ठीक है, फिर उसके बेस पे अगर कंपनी में कुछ ऐसे इवेंट है, सडनली सीईओ का रिजाइन होगा, जैसे फॉर एग्जांपल सीसीडी आप लोगों ने सुना होगा। ठीक है, हाँ, अब आज की जनरेशन तो सभी सुनती है। तो सीसीडी के एक सीईओ थे, या उनके मालिक थे, आई थिंक सिद्धार्थ अमैया, ही कमिटेड सुसाइड एक्चुअली। तो उस यू जस्ट सी कि व्हाट हैपन एग्जैक्टली विद सीसीडी प्राइस दैट टाइम। तो वो just one day before and one day after that suicide, CCD stock price fluctuated like anything. I'll show you. Mm, I think इनके पास पिछले 10 years का डेटा हुआ, then I'll try to show you. I think this was the not in 2021. This incident did not happen. I think this happened around here. So see, the share is 44.1. This is CC. No, this is not CCD. Sorry. CCD is out of stock also. KFA of it. It is delisted from the stock actually, but that time it was on. It was listed on Bombay Stock Exchange or somewhere. So sorry, it is removed from now because हाँ, तो ये भी एक मैं बता रहा हूँ कि कैसे एक सीधा सा इंसिडेंट उसकी सुसाइड के बाद हुआ कि सीसीडी हैज टू एक्चुअली delisted from the stock exchange. Otherwise, it was doing very well that time. Okay, so I think there are some news around it. It was trading around 50 cent, but before that it was trading around more than 100. So ऐसे these kind of incident may affect a company performance. Then there is a kind of situation liquidity कि जहाँ liquid trading volume would be low, liquidity would be low. Liquidity would be low in the sense that there are not enough participants to participate in the market. There are not enough buying and sell orders so that you can easily buy and sell your assets. Asset in the sense your bonds and all. And that if liquidity is less or trading volume is less, the market will be more volatile because कोई भी एक like कोई भी छोटी चीज can trigger bigger changes in the price. Okay, and now coming to the what is the role of volatility in investing? Definitely you have better understanding of volatility, तो आपके decisions अच्छे होंगे, you know in better manner कि कहाँ आपको invest करना है, कब आपको you have to stay away, और कब आपको you have to take precautionary measure. This kind of understanding will help you in making better and well informed investment decisions. Okay, and then there's something called price option, that is कि ऐसे black and scholes model में होता है, when you option price do and all, it is a subject of derivatives. I don't want to confuse you guys here, but in derivative volatility play a big roles, like how to decide the price of a option. जब ये ऑप्शन में हम प्राइस डिसाइड करते हैं तो दैट टाइम आल्सो वी कंसीडर वोलेटिलिटी, बट दैट इज अ सब्जेक्ट ऑफ डेरिवेटिव। राइट नाउ आई डोंट वांट टू कंफ्यूज यू गाइस विद दैट। ओके, देन हमने एक सिनेरियो दिया था कि हाउ टू कैलकुलेट योर वॉलेटिलिटी, जहाँ पे 2 बॉन्ड के डेटा दिया था, एक का एनुअली था और एक का मंथली था, ठीक है। तो सपोज यहाँ पे कैलकुलेशन दी गई थी, लेट्स कंसीडर ए हाइपोथेटिकल 10-year bond with a face value of $1,000 and a fixed annual coupon rate of 5%, which means it pays $50 in interest each year. Then what did we do? We tried to track how can we calculate volatility based on this information. Here I suggested you guys some step. The पहला step था आपको एवरेज वैल्यू निकालनी है, दूसरा स्टेप था आपको डेविएशन निकालना है। डेविएशन क्या होगा? एवरेज वैल्यू में से आप एक्चुअल ऑब्जर्वेशन को घटा दोगे, ठीक है। तीसरा था स्क्वायर डेविएशन, जो भी डेविएशन आएगा उसको आप 2 से उसकी पावर बना दोगे तो वो स्क्वायर डेविएशन हो जाएगा। फिर आप उसका वेरिएंस निकाल दोगे, वेरिएंस कुछ नहीं है बट आप सारा स्क्वायर डेविएशन को ऐड कर दोगे, उसको नंबर ऑफ ऑब्जर्वेशन या नंबर ऑफ मंथ जो भी दिया हुआ है उससे डिवाइड कर दोगे, एंड देन यू विल कैलकुलेट द स्क्वायर रूट ऑफ वेरिएंस, दैट वुड बी योर स्टैंडर्ड डेविएशन एंड दिस इज कॉल्ड योर वोलेटिलिटी। For this purpose, I showed one example also. और convexity का example भी था यहाँ पे। Okay. This was the example. हमने डेटा यहाँ पे ले लिया था, पहले था प्राइस। प्लीज ध्यान से देखना, ये क्वेश्चन आप लोगों के एग्जाम में भी कहीं आ सकता है, इससे छोटी फॉर्मेट में वो लोग दे सकते हैं। तो दिस इज वन ऑफ द इम्पोर्टेंट कॉन्सेप्ट, सो प्लीज पे अटेंशन टू दिस। सो हियर इट वाज मंथ, देन द डेटा वाज गिवन इन दिस कॉलम। पहले तुमने रिटर्न निकाला, तो फिर मैंने बोला था रिटर्न ना करके तुम लोग प्राइस से भी कैलकुलेट कर सकते हो, ठीक है। तो पहले तुमने ये हटा दो, ये मैंने ज्यादा ध्यान इसको नहीं किया था, प्राइस पे आप लोगों को करना है। तो पहले स्टेप था आपका एवरेज निकालना, यू कैलकुलेटेड द एवरेज लाइक दिस, और इन कैलकुलेटर यू कैन ऐड ऑल दिस एंड डिवाइड बाय द नंबर ऑफ ऑब्जर्वेशन। देन प्राइस में से दूसरा स्टेप था द डिफरेंस बिटवीन एवरेज वैल्यू एंड एक्चुअल वैल्यू। तो यहाँ पे हमने डिफरेंस लिया था एक्चुअल वैल्यू माइनस एवरेज वैल्यू, ये सारा यहाँ पे डिफरेंस आ गया था। देन इसका स्क्वायर करना था, स्क्वायर में एज आई टोल्ड यू, यू कैन ईदर यूज दिस फंक्शन इफ यू आर डूइंग इन एक्सेल, अदरवाइज जस्ट 1.25 मल्टीप्लाइड बाय 1.25, ऐसे आपने स्क्वायर डेविएशन यू हैव कैलकुलेटेड हियर। वंस योर स्क्वायर डेविएशन वाज हियर, तथा फोर्थ स्टेप वाज द वेरिएंस। व्हाट वाज द वेरिएंस? द स्क्वायर डेविएशन divided by the number of observation will be your variance. And what is volatility? The square root of variance is your volatility. तो ऐसे आपकी volatility you calculated, ठीक है। So these were the step: mean calculation, deviation, square deviation, variance, standard deviation, and then interpretation. Like what? That the price, the mean price, the standard deviation is 42. That on an average price is 1024, but the fluctuation could go around 42 or 42, or here it is 12. It is, I think, annual. It is annual. E60. It was annual. So your overall volatility was around 12%. Okay, so that's how you calculate the volatility also.
So what was the formula for volatility, sir?
Standard deviation, no?
So, but you
So
have not taken standard deviation. You've taken what? You've taken variance, square root of variance only,
variance
right?
and then square root of variance.
Okay. And then over a 12-month period, you have calculated this? I mean, what is this 42?
Yeah, so over the, that's what square root E16 multiplied square.
Square root of 12. Why have we taken square root of 12?
That's what I'm thinking. Even I got confused. What is E16 was 12.34, right? And the square root was square root for 12, I think. For 12 months we calculated this. This was your daily like per month volatility, but this was for wait a second. Shiro. Just a second. Sorry, my cat came. So that was Atul for annual actually. So for 12 months we took together here. Here it was for monthly. So monthly volatility is your 12%. Your annual volatility is 42%.
So why do we multiply it with the square root of time?
So when you calculate from daily to annual in the concept of volatility, you have to calculate the square. This is the formula actually.
Yeah,
In the
actually, that's what I was asking. What was that formula? I don't recall yet.
yeah, so formula is daily volatility multiplied by square root of number of days or number of years or number of months.
Okay.
So I told you, no,
But
that day.
yeah, but this
Yes.
is monthly, right? It's
Yeah,
monthly,
this is
and then we have taken
12
number
is
of months.
12
Yeah,
is monthly. Based on your month, you calculated it annually.
annually. Okay.
So monthly volatility multiplied by your square root of number of months. No, number of months are there 12.
Okay.
Even
So,
I got
so,
confused. I don't know why it is 42%. Then I just try to recall it.
so, I mean, then are we saying that? I mean, I'm trying to interpret this. You know,
Tell me.
12% price volatility is 12%.
Yes, it's in our case it is a price, not percentage. I'm telling generally we calculate in the percentage form. So it would have been percentage if I had taken here return. So just to make calculation easy, I just took price. So it is 12 rupees, or you can say
So,
$12.
so how do I interpret this? Like, I mean,
So you can
$12 what?
say on an
Price
average,
changes. Yeah,
yeah. So on
sorry.
an
Go ahead.
average, the price is 1024, but the volatility is $12, or you can calculate it in this percentage terms. But right now, just I'm again telling you, generally we calculate it in a percentage form. But to make a calculation easy, I calculated your standard deviation is 12. So here instead of calling volatility, volatility is $12, or you can call it standard deviation is $12, meaning that the deviation from the mean value, which is the 1024, is on an average per month $12. Okay, so it could be around 1036 or 1012.
Got you.
Okay, so $12 का ऊपर नीचे का fluctuation is there. ठीक है.
And when you are taking annual, then you are saying it is 42 rupees.
Yes, it's 42 rupees around.
Why should it be like that? I mean, why would we say that at an annual level the volatility will become, you know, higher?
Because the same property, no, the higher the time, more would be the uncertainty. So based on this, it has calculated on a monthly basis. If you cumulate it for the entire year, it would be 42. It is a cumulation actually, kind of.
Okay. Okay.
Okay.
Okay. Okay.
So it is like on a month basis, you have 12, but when you cumulate it for the entire year, it is around 42.
Understood. So, fine. I mean, in a year, you know, I'm expecting that it can go up to 66,
42.
1066,
Yes, yes.
1066 price can go.
Ah,
And even though the maximum that I have is 1048, but you know, there's an expectation that it can go up to 1.1066. Okay, fine. So I've understood this point.
yeah,
So
yeah.
what was the question asking? Like, can you go to the question?
Wait, so the question was, we will track its price over a simplified 1 year period to calculate the volatility.
The question is just to calculate the volatility. It doesn't say whether the price volatility or the return volatility, right?
Yeah, yeah. So that's why I calculated with the price to make your calculation easy, and that's why I did not take return here.
Fine. So this is a price volatility.
It's a
If I
price
have
volatility.
taken a return, then I would have got a different value, right?
Return
Obviously, you know,
volatility. Then you would have
return
got in a
different.
percentage form like 1% or 2%,
Right.
like this
Because
your
return is
volatility.
percentage, yeah.
I think if you remember that day I wanted to do it with return, but then I said, okay, let it make it a easy calculation and do it with price only.
Right. So, but if a similar question comes, then, you know, we'll take price only and do the volatility
Take price
calculation, right?
only in the exam.
Right.
If it comes,
Right.
I think definitely they will take my input also. So if it
Right.
comes in the exam, just calculate the price volatility
Price
only.
volatility. Okay. So another
Okay.
question I had was that this for all these stock markets like NSE, you know, they publish a VIX, VIX, right? I mean, and you were also showing that business standard thing where you were showing that the VIX has slumped down. So how do you calculate VIX? Is it same as price volatility or it is something else?
No. VIX is always implied volatility. It is based on your 30 days advance option price. So this is historical volatility. Based on January to December price, we calculated this volatility.
Okay.
Volatility
So, but there
index
you are taking a
is
30-day advance option.
Options, yeah. So
Okay.
we always say VIX is forward-looking approach. Like what may happen in next coming 1 month in the stock market, or
Yeah,
next
but
1 month
if I have that price,
Mhm.
I will still use and do a standard deviation only on that price.
Implied
I have to,
volatility, yeah, actually it would be standard deviation, but not on the historical price. It will take the option price of the next future 30 days
yeah,
or
I got
something.
you. I got you. See,
Uh,
once I'll put it into this format, I'll put it against the price only, right? I mean, with I understand it's not historical price; it is a future price, advance 30-day
yes, but
advance option
you will
price.
calculate your
But
deviation only.
yeah, yeah, it is the same thing I will do, right? Same formula,
Yeah,
everything will
you'll
be the same.
you'll no
Okay.
formula might be little bit adjustment, but it would be deviation. Yeah, definitely it would be standard deviation.
Okay. So you think VIX could be something else as well?
Yes, VIX could be something else.
Yeah. Okay.
Because it takes option, future price and all, and it has its own other factors also into consideration before calculating the actual volatility, but it would be standard deviation only.
Got you. Eventually, it will use standard deviation. Okay.
Yes, yes. Okay. And VIX is always forward-looking approach. Right now, what we do with historical volatility, we take historical price, try to calculate standard deviation, and then put into regression or something, and we try to expect what percentage change may happen, or what has been the historical volatility, based on which how will it happen tomorrow with the price. But implied volatility, because options are you take no like for 3 months, for 2 months, for like this, right? Based on those information, they look forward ki what could be the market sentiments in next 1 month, or in next 1 year, what could be the situation. So there actually what you are saying is right. There you take options, here you take price only, and you take historical data.
Yeah. So I'm just I just Googled, and I think
Mhm.
what it is saying is it is eventually it is calculating standard deviation only. So it says VIX index calculation takes the difference of two sets of
Mhm.
SPX options with
Mhm.
expiration dates between 23 to 37 days
Yes.
in the future. Then it
Mhm.
interpolates the variance between the two and then takes the square root to
Yes,
calculate the VIX. Yeah.
that's what I'm saying. It's a standard
Yeah.
deviation, but it's a forward-looking approach.
Yeah. Got you.
Okay.
And it's
Big.
basically it is also data. It is taking two sets of data. 23 days and 27 days
Yeah.
option price it is taking, and then um,
Interpolated.
and then it is yeah, then it is interpolating.
Yeah. Correct. Okay. So
It is taking
whenever
the
you talk
variance between the two. Yeah.
yeah, whenever you talk about volatility or deviation, it is always standard deviation. You want to measure. Actually, it is like I'll tell you how it is. You always try to understand what is your forecast compared to the actual situation. And the difference between your forecasting thing and actual thing is your deviation, is your volatility, is your differences, is your fluctuation, is your error. So I think if you remember last time also I was talking, you talk whatever machine learning things and all you talk, you will not raise beyond mean, median, mode, standard deviation and variance. So base is that only. Okay. Okay. Is it clear, Ratu? Shall we proceed?
Yeah. Yeah.
Mhm. Okay. Then the second question, we discussed the same thing only. So there you have prices, and I think it was given for your practice only. So you do practice with that, and with that we concluded the volatility, I guess. Okay, then we went ahead with the interest rate risk and oh, both are interest rate risk. Okay, so what is interest rate risk? We were talking about in the first slide also we discussed. It is also known as market risk, and how much an interest rate change may affect the value of investment or a financial instrument is called as interest rate. Like given the change in interest rate or fluctuation in the interest rate, how much it affects the value of the investment. It could be like your bond value or your sovereign bond value or your T-bill value and all. This is called the interest rate risk. Okay. Then we had components of what is this? Okay, the what how it can affect the price, how it can affect, and this we discussed. I think me and Atul also had this discussion over reinvestment risk also. Okay, when it happens, It happens when an investor receives cash flow, interest payment, or principal payment from an investment and need to reinvest those funds as potentially lower interest rate in the future. I think you asked some question also, Atul, you remember, I think, about
Yes,
reinvestment. Some
I did.
yeah, some confusion
Right.
was there, so we discussed that
Right.
also. So just go ahead with these slides also again. Then what are the implications of interest rate risk? It has multiple implications. It has implication for bank and financial institution because they have to keep the record of these changes and all. Ultimately, it will affect their assets and liabilities, and that's where we were trying to discuss this gap analysis and all and how to measure it. Then for bond investor, definitely investors are directly involved with this, and the fluctuation may affect the value of their firm. That is very well established by now because of given their relationship with the price. Then borrowers also will have their implication, and then we have pension fund and insurance companies because they do not invest like a small amount, a huge amount they hold in the bonds or sovereign bonds or corporate bonds and all. So a small change in the interest rate can significantly affect their overall price.